Hello everyone, welcome to this AS marathon. Uh, this AS marathon we are taking all the AS accounting standards which are applicable for group 1 of CA intern. So in all there are 8 accounting standards we'll be covering. Apart from that, even the part of the applicability of the accounting standard is also relevant for exam purpose, but because we have a limitation of the time, we will not be discussing the applicability of the AS in this marathon. But in the PDF that I have been sharing with you, the PDF is being shared with you, and the link is the Telegram channel link is given in the description below. Please follow the link and have your PDF ready in front of you while actually listening to these video lectures. So I will not be discussing about the applicability of the AS, however that will be shared with you along with the PDF. So you can refer to that little quick. It will not take more than 15 to 20 minutes for you to go through that. And then all the AS are covered one after another. After every AS, I have compiled all the questions which the ICA has provided from study material, from RTP, from mock test papers, from past exam questions. So all the questions, almost all the questions have been covered here. Around 100 questions are there in this this PDF that is being shared with you. So you take the full advantage of that and book your 20 marks, because if you listen to these marathon itself, which will be discussing the concepts in brief and few questions we will be discussing little quick, that would help you a lot in scoring at least 15 marks out of the 20 marks. Even 20 out of 20 is, why not, it's very much possible. So sir, are we going to discuss 100 questions? Not at all. It's not possible to discuss all the 100 questions, but I'll be providing you with the 100 questions. We'll be discussing few questions in this marathon, few important ones. I have jotted down the question numbers, few important ones we'll be discussing, and other questions you can do yourself. I have given you a compilation at one place. All your requirements of group 1 accounting standard gets covered. Guys, without wasting time, let's start with the accounting standard 1, disclosure of accounting policies. Okay. So, because there is still a possibility, accounting standards actually what they try to do, all the accounting standards, they are trying to harmonize the accounting policies. So they are trying to minimize the options available for different accounting policies to be followed by different entities. But still guys, there are various areas in which different accounting policies are possible. Many areas are there. And because of that, the disclosure of accounting policies in the financial statement itself is very important. If you look at any entity, the financial statements contain a very important part called as significant accounting policies, and there at one place in the financial statements they disclose all the accounting policies. Maybe accounting policies related to inventories, accounting policies relating to the property, plant and equipment, or fixed asset as you call it, intangible assets, taxes on income. Almost on all the areas they will give you the significant accounting policies at one place, and which is a requirement of AS, that disclose all significant accounting policies and disclose them as an integral part of the financial statements and disclose them at one place. Apart from this disclosure requirement, AS1, the name itself is disclosure of accounting policies, talks about one very important aspect, which is fundamental accounting assumption, guys, which is fundamental accounting assumption. Okay. What are the fundamental accounting assumptions? 3 fundamental accounting assumptions. One is a going concern. That means we view the entity as continuing its operations for foreseeable future. We do not have intention to close down or materially curtail the scale of operations of the entity, because if that is the purpose, suppose we are closing down in 1 year, then this going concern assumption is not valid. Then the financial statements are to be prepared on a different basis. The basis would be mostly the fair valuation or realizable value basis, and not on the historical cost conventions, which is in most of the cases applied in accounting standards. So first is obviously the going concern assumption. Second is consistency, means the accounting policies you cannot change. That means for in the first year, suppose I followed a WDV method, then I changed it to straight line, or in the first year I suppose say followed a FIFO, then I changed to weighted average, then again I changed it to FIFO. Like that, it's not acceptable, because consistency means practice of using the same accounting policies year on year is what is expected. However, accounting policy can be changed. It can be changed only in certain circumstances. The AS says that it can be changed when it is a requirement of the statute that you change the accounting policy. The law changes, some legal requirement comes in which requires a change in accounting policy. Do change. It is required by an accounting standard itself. Accounting standard itself. Now, for example, the old AS10, which was relating to the fixed asset, has been replaced by the new AS10, property, plant and equipment. And the many requirements, especially relating to the subsequent cost when replacing the parts, etc., has significantly changed. So if because of that you need to change the accounting policy, you have to change it simply. And third, if it is required for a more appropriate presentation of the financial statements, because you were following a certain policy earlier, but now you believe or your perception is that the better presentation of the financial statements requires certain change in accounting policy, you do change it. However, while you make that change, what are the disclosure requirements, what are the requirements of AS1, we are going to see. But otherwise, this change in those exceptional circumstances can be made, but otherwise consistency is the policy, is the assumption, not a policy, is an assumption. So going concern, consistency, and third very important assumption is obviously accrual. Accrual is assumption, that means the transactions are recognized as soon as they occur, whether or not cash has actually been paid or not. For example, they may ask you a question that suppose there is a loan which is outstanding and the interest cost, the entity says that because the interest is not paid and we might go for a settlement, something like that, because of the bad financial condition, the entity is unable to repay the loan, and because of that they are saying that we will not make a provision for the interest, but we will record the interest, recognize the interest cost as and when we'll actually pay the interest. Is that policy allowed? The answer is of course no, because accrual is a fundamental accounting assumption. We prepare the accounts on accrual basis. Three fundamental accounting assumptions: going concern, consistency and accrual. If these assumptions are followed, which are usually followed by any entity, do you need to separately disclose that the accounts have been prepared on a going concern basis? We have followed the consistency in the accounting policies, and we have been preparing the accounts on the accrual basis. Do we need to state that? The answer is not required to be disclosed. So if they are followed, absolutely they are not required to be disclosed. But if they are not followed, a specific disclosure in the financial statement is required. If certain fundamental accounting assumption is not followed, for example, if the going concern assumption is invalid, the disclosure is definitely required. Then what are the considerations that govern the selection of particular policy? See, whenever there is a choice of selecting from different alternatives, you have accounting policies to select and there is a choice. In that case, you should keep in mind the three factors. One is prudence, second is substance over form, and third is materiality. These are the factors you should consider. What is prudence? By prudence, one by one we'll address everything. Prudence. By prudence we mean we make provision for all known losses and liabilities. However, while recognizing any asset, any receivable, any claim, we are extra cautious because of the conservatism, because our purpose is fair presentation, and that requires us to provide for all known liabilities and expenses and losses as well, but not to recognize contingent assets. That means we are ensuring that the assets are not overstated and the liabilities are not understated and the profit is not overstated. For example, let me give you an example. For example, suppose the construction contract is going on Obviously A7, which is not there in group 1, is applicable. And in that case, suppose you know that your total estimated cost will be more than the revenue. That means you know the amount that will be booked as a loss. If you know it today, even if a part of it might actually occur in the subsequent year, because you know it today, make a provision. That's what prudence demands. As simple as that. However, in most of the times, the asset while recognizing, for example, if you are also studying AS22, then for recognition of deferred tax asset, we ensure the reasonable certainty. And if it relates to the losses, etc., virtual certainty is what is expected. So that is prudence. Substance over form. The transactions are recorded by going by the substance of the transaction, not merely its legal form. For example, lease, finance lease, AS19. Finance lease, even though you do not own, even though the one who is taking the asset on lease, the lessee, is not owner of the asset, as on paper he is not the owner, but he recognizes that as an asset. This is called as substance over legal form. And materiality, obviously, if you are also studying group 2 and audit, you know what materiality is. The same is the logic here, that the financial statement should disclose all material items. So sometimes a very negligible minor items can be considered below materiality and will be ignored for that purpose. For example, I'll give you a simple example. If your entity is like, say, having a turnover of few thousand crore rupees, and obviously you have a big corporate office wherein many office supplies are given, like for example calculator, and you are very particular and you use calculator say for 3 years. Every calculator is used for 3 years. You are that conservative in actually utilizing the resources. So do you recognize that as an asset? Of course not, because it's such a small value item that recognizing that as an asset is, I mean, you can expense it off. It is a way below your materiality level. You can simply expense it off. So there are various examples of materiality that can be given. So questions they might ask on fundamental accounting assumptions. There might be questions on these 3 things. These are the considerations in selecting the accounting policies, which are obviously these 3. One is prudence, substance over form, and materiality. Let's go ahead. If there is a change in accounting policy, and we just discussed this, in these 3 case circumstances, the change in accounting policy can be done. But if there is a change and if it has a material effect in the current period, there are 2 possibilities. The change in accounting policy has significant material effect in the current period on the profitability or on the assets and liabilities, but it is also possible that it has no material effect in the current period, but it is likely to have material effect in the subsequent periods. So for example, you are changing the accounting policy in 2021. There is a possibility that in 2021 there is no material change, but because you have changed now, in the subsequent year it is likely to have material effect. In both the cases, disclosure is required. So if it's in the current period, then you ascertain the amount of change. Means because of the change in accounting policy, the profits are either understated or overstated. Assets, liabilities are either understated or overstated because of the change, owing to the change. Then you ascertain that amount and disclose that amount. So disclose that amount as well, along with obviously the disclosure of change. And if the amount is not ascertainable, then you mention that this accounting policy has been changed and disclose the fact. You state a fact that this amount is not ascertainable. And even if the change might not have material effect in the current period, but it is likely to have material effect in the subsequent period, even in that case, disclose in the current period itself. There could be multiple questions that could be created out of this. So please remember this one thing. Change in accounting estimate is obviously different from change in accounting policy. If there is a change in an accounting estimate, the only calculations change, then this disclosure of change as a change in accounting policy is obviously not required. Now, as I said, I have given you the compilations of various questions. In accounting standard, this much discussion is sufficient. In accounting standard 1, I have given you multiple questions which you should prepare, at least read them once before going to the exam, but we'll be discussing few. Okay, let's discuss few out of these. So let's, for example, discuss question number 1 first. I'll be discussing 3 questions for AS1. The first one is question number 1. In the books of Messrs Prashant Limited, closing inventory as on 31st March amounts to 1,63,000 on the basis of FIFO method. So that means currently they are doing it on the basis of FIFO. The company decides to change from FIFO to weighted average. So they want to change for ascertaining the cost of inventory from the year 11-12 or 21-22. Okay. Then on the basis of weighted average method, the closing inventory changes to 1,47,000 and the realizable value is obviously more. We know that the inventory is to be valued at cost or NRV, whichever is less. So discuss the disclosure requirement as per AS1. Whenever the exam question asks you, you can split the answer in 2 parts. Okay. So just for telling you how you can present it, I have put it in 2 parts. This same methodology you can follow for all the subsequent accounting standards. So first I am writing the accounting standard provision and then I am writing analysis and conclusion. So I am discussing this in 2 parts. Let's first talk about the provision. What it says is any change which has a material effect should be disclosed. The amount also should be disclosed to the extent ascertainable, and where the amount is not ascertainable, the fact should be indicated. Now here, is the amount ascertainable? The answer is yes, because as per FIFO you know the value, as per weighted average you know the value. The difference, let me calculate the difference. 16,000 is a difference. So this is an impact on the current year's profit. And how we will disclose it? The company values its inventory at lower of cost and net realizable value. Since the net realizable value of all items of inventory in the current year was greater than the respective cost, the company valued its inventory at cost. Obviously, at cost, NRV is more. In the present year, the company had changed. This is the important part. In the present year, the company had changed to weighted average method, which better reflects the consumption pattern of inventory. This we are assuming. Why they are changing it? For a better, more appropriate presentation. It's not a requirement of the statute, it's not a requirement of any new AS, but maybe it is for the more appropriate or better presentation. For ascertaining cost from the earlier practice of FIFO, the change has reduced the current profit and value of inventory by 16,000 rupees. This is an impact. The amount also we are disclosing. So this is how they may ask a question in exam. Let us now go to, guys, question number 4. Other questions you will read. Prepare yourself. This question is again from the module, asked twice in mock test paper April 21 as well as May 20. True or false? First one. Certain fundamental accounting assumptions underline the preparation and presentation of the financial statements. They are specifically stated because their acceptance. They are usually specifically stated because their acceptance and use are not assumed. True or false, guys? See, do we disclose that the fundamental accounting assumptions have been followed? The answer is obviously no. So this statement has to be the false one. Okay. So our answer, let's read the answer. False, because where is the answer? Yeah. As per AS1, certain fundamental accounting assumption underlie the preparation and presentation of financial statements. They are usually not specifically stated because their acceptance and use are assumed simply, and disclosure is necessary if they are not followed. Let's go to the second question. If the fundamental accounting assumptions are not followed in the presentation and preparation of the financial statement, a specific disclosure is not required. Again, a false statement. If they are not followed, specific disclosure is required. We'll restate the correct statement. Third, all significant accounting policies adopted in the preparation and presentation of financial statement should form part of the financial statement. Of course, yes, a true statement. The reason would be just repeat the same statement and just add something if you know in addition. Like in this case, for example, they should be disclosed at one place. Any change in accounting policy, I'm reading question 4. Any change in accounting policy which has a material effect should be disclosed, where the amount by which any item in the financial statement is affected by such change is not ascertainable, wholly or in part. The fact need not be indicated. Again, this is a false statement, guys. This fact must be disclosed. If the amount is ascertainable, amount should be disclosed. If the amount is not ascertainable, the fact that it cannot be ascertained should be disclosed. And there is a single list, there is no single list of accounting policies which are applicable to all circumstances. This is absolutely a true statement, guys. There is no single list which is applicable in all the cases. So absolutely a true statement. Okay, then let's go to question number 5. HIL Limited was making provision for non-moving stocks based on no issues having occurred for last 12 months up to 31st March 2019. So they are making a provision for non-moving stock, guys. The company now wants to change it and make a provision based on technical evaluation during the year ending 31st March 20. See, what is your change? Based on issues, and now they want to make a provision based on technical evaluation. The total value of the stock as on 31st March 20 is 120 lakhs. Provision required based on technical evaluation amounts to 3 lakh. However, provision required based on 12 months, no issue, means it's how much is a non-moving, based on that is 4 lakh. You are required to discuss the following points in the light of AS1. First, does this amount to change in accounting policy? Second, can the company change the method of accounting? And third, explain how it will be disclosed in the annual accounts of HIL Limited for year 1920. So guys, do you think that it is a change in accounting policy? See, they are currently making a provision, and they also will be making a provision in future. So first, making a provision is a policy, correct? They are making a provision for non-moving stock. Earlier they are making on based on no issues, something like that, for last 12 months number of issues, no issues, and now they want to do it on based on technical evaluation. In my opinion, this is simply change in the method you are estimating. So it's a change in accounting estimate and not a change in accounting policy. So this is a mock test paper question. Let's read the answer. The accounting policies we have defined first. What does it mean? They refer to the specific accounting principles and the methods of applying those principles adopted by the enterprise in the preparation and presentation of financial statements. And as per AS1, change should be disclosed. Now we come to the second question. We first write the provision. Now this does not amount to change in accounting policy. Straightforward answer is written, does not amount to change in accounting policy. Accounting policy of a company may require that the provision for non-moving inventories should be made on the basis for making provision will not constitute accounting policy, but the method of estimating may be changed. In case it's a more prudent estimate can be made, obviously. So how it will be disclosed? It will not be disclosed as a change in accounting policy. The disclosure can be made by way of a notes to accounts in the annual accounts in the following manner. Disclosure can still be made. See, any additional disclosure. AS requires disclosure of change in accounting policies. If some method is changed, it may not be disclosed as a change in accounting policy, but for a better presentation, any additional disclosures, obviously for a fair presentation, you know that, can be made, and it can be accordingly disclosed like this. Okay. So with this, guys, we end our discussion on AS1. only most likely questions are either true or false, or on a change in accounting policy, or maybe they may ask you a question on fundamental accounting assumptions, and if they are followed, whether disclosure is required. Of course not. If they are not followed, the disclosure may be required. And we will end our discussion on AS1. Guys, let's move on to AS2. AS2, valuation of inventories. Okay, so let's quickly start with the definition of inventories. Inventories are defined as assets held. So basically inventories are assets held for sale in the ordinary course of business. Like for example, if you are a trader, then your traded goods inventory in the process of production for such sale. If you are a manufacturer, your finished goods inventory, because it's for a sale in the ordinary course of business. And if you're a manufacturer, the inventory which you need for example, raw material inventory also would be covered. All the materials, consumables, work in progress inventory, all those would be covered here. And for the consumption in the production of goods or services for sale. So all the inventories of raw material, WIP, finished goods, consumables, all are covered here. So inventories encompass traded goods inventory, land and property held for resale. If it's for a resale, that finished goods, WIP, raw material awaiting use in the production, maintenance, supplies, all are inventories. However, if spare parts, servicing equipments meet the definition criteria of property, plant and equipment as per AS10, then AS10 applies, not AS2. What is excluded from the scope? First, WIP arising under construction contracts, AS7 takes care of it. WIP arising in the ordinary course of business of service providers, it's like for example unbilled revenue or service work in progress. For this, AS2 is not applicable. Shares, debentures, other financial instruments held as stock in trade, AS13 will take care of that, not AS2. And very important, because on this also they may ask a question, produces inventories of livestock, agriculture and forest products and mineral oils, ores and gases to the extent they are measured at NRV in accordance with the well-established practices in those industries. For example, if there are firm commitments, especially when there is like guaranteed contract and the amount of how much you are going to receive is known, like we call that as a firm commitment kind of a thing, then these producers inventories of livestock, agricultural produce, etc., then to this AS2 is not applicable. But if it's not a producer inventory, if like it's like for example, they have asked one question in the recent RTP or MTP also, that for a manufacturer is producing a towel, bath towels, and they want to value it at the sales price because they have a committed contract. Even in that case, the answer is no, because AS2 basic principles we know, cost or net realizable value, whichever is less. Inventory should be valued at lower of cost and net realizable value, and this rule is to be applied item by item basis and not by global basis. Means you put all the inventories together, take a total cost, total net realizable value, whichever is less. No, that's not the rule. For every single item of inventory, if like for example you have 10 different types of raw materials, for every material you apply this rule, cost or NRV, whichever is less. If you are like 10 different products which you are producing, for every product you apply this rule, and for WIP of every product you apply this rule. Okay, cost and net realizable value. So we have to focus our attention on cost as well as on net realizable value. What is net realizable value? How do we compute the net realizable value? It's very easy. Net realizable value is equal to NRV is equal to estimated selling price in the ordinary course of business, selling price minus cost to complete minus selling cost. Estimated cost to make sales like brokerage, etc. So in most of the questions you might have to calculate NRV. They will give you a selling price. Suppose if it's a WIP, they will tell you that to complete the WIP, to convert it into finished goods, how much additional cost is required. So that will be estimated cost of completion, and they will also tell you for selling purpose, certain selling expenses, commission, brokerage, etc. Then that would also be reduced to calculate net realizable value. How do you calculate cost, guys? How do you calculate cost? Now, cost will include first cost of purchase, then conversion cost, and then other costs. Okay. The two important parts, first is cost of purchase. Obviously, cost of purchase would be relevant for traded goods inventory as well as for material. If it's a WIP, cost of purchase of raw material plus conversion cost would be considered. If it's finished goods, cost of purchase plus conversion cost would be considered. So what is the cost of purchase? The basic principles apply. Purchase price, duties and taxes which are not recoverable from taxing authorities. For example, if it's a GST and if the ITC is available, we will not consider that as a cost. If ITC is not available, we'll consider that as a cost. So basic customs duty etc. will consider that as a cost. Freight inward and directly attributable expenses to the acquisition, transit insurance, everything would be included. However, if the duties and taxes are recoverable, we exclude them, and trade discount, rebate, duty drawbacks, similar kind of items are to be excluded from the cost of purchase. Very important is conversion cost. Conversion cost, converting raw material to finished goods. We ordinarily know that the conversion cost is labor plus overheads. If you are also studying cost accounting, you know what is conversion cost. The same logic applies here. It's basically direct labor cost and production overheads. And A says that production overheads could be fixed as well as variable. Fixed production overheads are to be absorbed systematically based on normal capacity, and variable production overheads are to be assigned on the basis of actual production. Guys, if you have studied the chapter overheads of cost accounting really well, you will exactly understand how this will happen. As far as the fixed overheads are concerned, you will consider the normal capacity and you will absorb the fixed overheads. So suppose there is your production is less than the normal capacity. In that case, there will be an under absorption of the overheads. So the amount which is not absorbed will be charged off to profit and loss account automatically. Means it will not be included for the inventory valuation purpose. So automatically it gets charged off to profit and loss account. If, however, if there is a production more than the normal capacity, very rarely, but it may happen that the production is more than the normal capacity, then what happens is there is an over absorption. Still, if you are absorbing on the basis of the normal capacity, there is an over absorption. That means you are absorbing more overheads than actuals, and this is exactly against the principle of prudence. Guys, if under absorption there is no problem, over absorption, what is the problem? Prudence will not get followed. So because you are recognizing more cost in the inventory, so in that case, however, we have to again consider the actual production as normal and accordingly make an adjustment so that the cost is not more than the actual cost. Okay, in our regular classes I have taken that example as well, and those videos are also available on my YouTube channel. If for this particular point you have a doubt, you can refer to that video. And variable production, because they are variable, you know, variable is constant per unit, so you can use actual production as a base. So many a times they give you, for example, they give you that the fixed overheads are 4 lakh rupees and the normal capacity is 1 lakh. Then whatever may be the actual production may be less than that, but you will take 4 rupees because it's based on the normal capacity, guys. And other costs which are incurred to bring the inventory to its current location and condition. Sometimes specific designing charges, sometimes specific software charges which is essential to make the inventory can be included. However, what about interest and borrowing cost, guys? It is not included. Interest and borrowing cost is not included in the value of the inventory. Very rare exception situation is Include where the inventory necessarily takes substantial period of time for getting ready for its intended use. For example, wine. In wine producing, they say that the older is better. They just preserve the wine for a longer period. They keep it for a longer period so it attains more selling price, it attains more value. And if that is the case, so time is the essence and it takes substantial period of time just to become sellable. In that case, interest and borrowing costs may be included in the value of the inventory, but otherwise normally interest is not to be included and exchange difference are never taken to in the inventory costs. Okay, so for net realizable value, selling price minus cost to complete minus selling cost. For cost of purchase, include all taxes, directly attributable expenses, etc., etc. Exclude the taxes where ITC is available. Exclude the trade discount, rebates, duty drawbacks, etc. Conversion cost, direct labor and production overheads. Production overhead, fixed overheads, normal capacity, variable overheads, actual production, and other costs may be included like cost of this specific design, etc. However, interest is not to be included normally, and exchange differences, exchange losses are not to be included in the inventory cost. So we discussed what is cost, what is NRV. Now we go ahead with very important part. This is very important chart. We said that inventories are to be valued at cost or net realizable value, whichever is less. However, that is to be read along with this very important chart. And because the same, this is logically we are doing cost and NRV, whichever is less, but the principles change a bit when it comes to raw material and when it comes to finished goods. For raw material and consumable, what is the rule, guys? For raw material and consumable, if finished goods are sold at or above the cost, and if the finished goods are sold below the cost, there could be two situations. Now please understand this. Suppose you are using metal as a raw material for manufacturing this pen. Metal is a raw material, you are manufacturing this pen, and this pen is selling at profit. At profit I mean its selling price is more than the cost. This is getting sold at profit. In that case, for raw material there is no problem. You can continue valuing it at cost. Simply at cost you continue its valuation. Then you are not required to judge the selling price of the metal itself. Guys, please understand this. Metal is a raw material. I have some metal and I am going to use this in manufacturing of this pen, for example, and this pen is selling at profit. Then I need not worry about the valuation of material. I simply value it at cost, even though its selling price or replacement cost may be different. But however, if this pen, the manufactured product, the finished goods are selling at less than the cost, means this is selling at loss, then I am worried about the raw material valuation. In that case, I value it at replacement cost, because I believe that the replacement cost is the best measure of NRV. Cost at which that material can be replaced is different from its actual cost. And in exam, most of the times they will give you the replacement cost. Then if the finished goods are selling at loss, for raw material you will apply replacement cost. If the finished goods are selling at profit, for raw material you will continue with the actual cost. And obviously for FG and WIP, a straightforward rule of cost and NRV, whichever is less, would apply. This is very important. Many a times I have asked a question on this aspect. And what are the cost formulas, guys? By cost formula we mean a specific either formula like FIFO, etc., or sometimes the formula that approximates the actual cost is allowed by AS. Let's see. There are two types: formula based on actual cost and methods which are used for convenience. Based on actual cost, you can go by specific identification method, means items that are not ordinarily interchangeable, and goods and services produced and segregated for specific projects. Like for example, I know some job or process or project is going on, and I have a specific material assigned for that job and it is lying in my stock. You can go by a specific identification method. Means some material has been issued and some is lying. The one is lying, you know from which purchase, exactly from which purchase invoice it comes from, so you can apply that specific identification method for inventory valuation. However, most of the times the similar type of material is used again and again and again. For example, if you are using say metal, any metal, say steel you are using, MS steel if you are using, that means you can use it in many products, and the inventory is rotating, it's ordinarily changeable. So when there are large number of items of inventory which are ordinarily interchangeable, then we go by a formula which is FIFO or weighted average. That means, sir, is LIFO allowed? No. Is any other method other than FIFO and weighted average allowed? No. Only specific identification method if they are not ordinarily interchangeable. If they are ordinarily interchangeable, most of the cases they are ordinarily interchangeable, FIFO or weighted average. Only two cost formulas are allowed. Nothing other than this. LIFO is not allowed, guys. And sometimes you may go for standard cost or retail method. We will take one example of a retail method. I'll tell you what a standard cost is, you know, but the condition laid down by AS1 is that it should be fairly approximately equal to actual cost. You will set a standard as per your own whims, and the standard is far away from the actual, that is not allowed. It should be closely equal to actual, approximately equal to actual cost, then it is allowed. Retail method means like a GP percentage method. We'll take one example and you will understand retail method better. What we do is, we know usually there are many items which are traded, etc. We know a gross margin percentage, let's say 20%. Then whatever has been sold, we will deduct 20% to arrive at the cost, and we know the opening inventory, we know the purchase amount, and from that the cost of sales, if we deduct, means cost of the goods sold, of traded goods sold, if we deduct, the balancing figure would be the closing inventory. This is another way of using a convenient method for obviously inventory valuation, which is allowed by AS2, guys. What are the costs which are always excluded from inventories? Abnormal amounts of wasted material, labor, and other production costs. They give this example also. Sometimes they ask normal wastage is 5%, actual wastage is more than that. Then you will calculate, normal wastage is absorbed by good units. If you are a cost accounting student, this calculation is like nothing for you, and abnormal will be separately taken to profit and loss account. Means we will not absorb the abnormal loss into good units. So for example, if like for example 1000 units is input and 10% is a normal loss, then your output is 900, then the cost of this 1000 will be recovered by 900 units. But if the actual loss is more, let's say actual output is only 850, then again it will be absorbed by 900. Out of that, 850 will be the cost of the material and 50 will be transferred to P&L account. We will take one example to understand this better. In the questions we'll cover that. Storage costs are never included in the cost of inventory. Admin overheads, selling and distribution overheads are never included. Interest is never included. Exceptional cases are there. And exchange losses are never included in the cost of inventory. We will be taking a few questions now. I have selected shortlisted 5 questions which I believe important and would cover most of the aspects of AS2. Guys, the questions now. First, we'll be taking up question number 2. A trader purchased certain articles for 85,000 rupees. Purchase 85,000. He sold some articles for 1,05,000. The average percentage of gross margin is 25% on cost. 25% on cost. That means if the cost is 100, profit is 25, selling price is, this is a cost, this is a selling price, this is profit. Correct? 25% on cost. Opening inventory cost is given 15,000. Determine the cost of inventory. This can be done in various ways, but I'll explain you by way of a trading account. Suppose if you prepare a trading account, then you have sales 1,05,000. You have opening stock. Opening stock is 15,000. Purchase 85,000. Now, if you want to calculate a profit, which is 25% on cost, so the profit would be 1,05,000 into 25 by 125. 20% on sales, or 25 by 125. So 1,05,000 into 25 by 125, it is 21,000. This is my GP, opening stock, purchases, sales, and the balancing figure would be, you can calculate that. Let me calculate. 15,000 plus 85,000 plus 20. This is 1,21,000. This is also 1,21,000, and the balancing figure is 16,000, which is my closing inventory. You can you make use of a trading account for this purpose. Else, this is another method. First, I have taken the sales value of opening stock and purchase. Sales value of opening stock and purchase 1,25,000. Why? Because the profit is 25% on cost. 85,000 purchase, 15,000 is stock, opening stock plus profit. From that I deducted the sales, so I get the sales value of unsold stock. This is unsold stock at sales value. From that I deduct a margin 25 by 125. I get a cost of inventory. And another way could be, instead of sales value here, suppose I take cost itself. Suppose I took a cost here. This would be, cost would be 1,85,000 plus 15,000. Now the sales is 1,05,000. I will calculate the cost of this 1,05,000. I'll do 1,05,000 into 100 by 125, because if my profit is 25% on cost, sale is 125, cost is 100. A cross multiplication thing. So 1,05,000 into 100 divided by 125 gives me 84,000. I'll deduct this 84,000. I'll straight away get cost 16,000, which is a cost of my closing stock, and the closing inventory will be valued. So this is a retail method, a question on retail method, guys, which is a convenience method in the cost formula. Okay. You can mark it here if you want. You may mention this is a retail method. The question doesn't say anywhere, but that's how it is. Then I have selected question number 6. Let's see. You are required to value the inventory per kg of finished goods consisting of. So you have to value the finished goods inventory. Material cost per kg is 200, labor 40, variable overheads 20, fixed production charges, normal working capacity of 2 lakhs kgs is 20 lakh. So you can immediately calculate, if my overheads, fixed overheads are 20 lakh upon normal output is 2 lakh kgs. So that is 10 rupees per kg are the fixed overheads based on the normal capacity, absorbed on the basis of the normal capacity. So in accordance with AS2, the cost of conversion include a systematic allocation of fixed and variable overheads that are incurred. So how will the valuation be done? 200, 40, 20 and 10 rupees fixed overheads, total 270, and 4,000 kgs are in finished goods stock. So 4,000 into 270, 10 lakh 80,000. Sometimes a question is as simple as this, which will give you full marks. Okay, very easy question. Next, I have selected question number 9. Mr. Mehul, very important. This question with change in numbers has been asked many a times, guys. Many a times. Very important question. Mr. Mehul gives the following information relating to the items forming part of inventory as on 31st March 21. His factory produces product X using raw material A. So understand this. X is a finished goods, A is a raw material. One by one we'll read. First, 600 units of raw material A purchased at 120 and replacement cost is 90 rupees per unit. Now for raw material, please try to recollect the chart. For raw material, if the finished goods are sold above at profit or at loss, let's see if there is any information about the finished goods, because otherwise we cannot answer. In the third part they are saying expected selling price of product X is 300. So finished goods are selling at 300. Let's find out its cost. 1500 units of finished product X, total cost incurred is 320. Means finished goods ka cost is 320, cost is 320, selling price is 300. That means they are selling at loss. Finished goods are selling at loss, or in the terminology used by AS, it is selling at less than its cost. In that case, we will take a replacement cost. So answer would be, it will be written down to replacement cost as the market value of the finished product is less than its cost. So valuation will be done at 90 rupees per unit. Second question, 500 units of partly finished goods are in the process. I'm reading the second question now, guys. Focus on the second question. 500 units of partly finished goods in the process of producing X and cost incurred till date is 260. These units can be finished by adding 60 rupees. Additional cost is 60 rupees. We know the selling price, guys. Correct? Selling price is 300. And so how will we do is selling price minus cost to complete 60 rupees. Selling price is 300 minus cost to complete 60. This is my NRV. 240 is my NRV. And cost is 260. Whichever is less. So it will be valued at 240 rupees, guys. Lower of cost or NRV. Correct? 240 rupees. And last 1500 units, NRV 300, cost 320. So of course NRV. So here so you can see 90 rupees, 240 rupees and 300 rupees. This is how the inventories of raw material, WIP and finished goods would be valued. Okay. Let us go to, I have selected the question 10 as well. Let's read question number 10. A private limited, this is mock test paper May 18 question. A private limited company manufacturing fancy terry towels had valued its closing inventory of finished goods at a realizable value. They are using a realizable value method, means selling price, market value. Okay. Inclusive of profit and the export cash incentive. They are also including export cash incentives in that. Firm contracts had been received and goods were packed for export. Firm contract means the contract where there is a certainty that they will be concluded, but the ownership had not been transferred to the foreign buyers. You are required to advise the company on the valuation of the inventory. See, its answer is very obvious. First, is it a producer inventory? It do not fall in the category of agricultural crops. It's not a producer's inventory. So the simple principle of cost or NRV, whichever is less, has to be applied. Whenever a sale will happen, you book a profit. But if you are booking it profit even before the sale is happening and you are showing the inventory at realizable value, it is against prudence, guys. It is against prudence and AS does not allow that. So obviously AS doesn't allow. So naturally what you have to do, you have to consider cost or NRV, whichever is less. This policy is incorrect. Okay. Can quickly go through the answer. The final conclusion is not correct. The policy of the company is not correct, is my final conclusion of this. We'll be taking up one more question, guys. Question number 11. Let's read the question. A Limited is engaged in manufacture of chemical Y for which raw material X is required. So your Y is a finished product, X is a raw material. The company provides you the following information. Raw material cost is given 380, unloading charges will be included, freight will be included. So that makes a cost 380 plus 20, 440. Replacement cost is 300. Chemical Y, the material consumed is 440, labor 120, variable overheads are 80. We do not know about the fixed overheads, maybe the information is given. Let's read. Total fixed overheads 4 lakh, normal capacity 20,000. We will do 4 lakh divided by overheads upon the output 20,000. 4 lakh divided by 20,000 is 20 rupees per unit is the fixed overhead. So you just will add all these up. 440 plus 120 plus 80 plus 20. Total including 20 fixed overheads is 660. This is my cost of chemical Y, cost of manufacturing chemical Y. Then they give you the closing balance of X is 1000 units and Y is 2004. This rupee symbol is printed by mistake. 2400 units. And show the value when NRV of the chemical Y is 800. See guys, cost of chemical Y is 660. If NRV is 800, then finished goods are selling at profit, guys. Finished goods are selling at profit. And if the finished goods are selling at profit, raw material inventory will be valued at cost, which is 240, not the replacement cost. It's actual cost, which is 440 rupees. So that will be the value in case of first case 440, and finished goods will be valued at cost or NRV, whichever is less. So definitely they will be valued at cost. In the second case, when NRV of the chemical is 600 rupees, now NRV is 600, that means you are selling at loss. So for raw material we will use a replacement cost, and for finished goods we will use NRV because it is less. As simple as that, guys. But you have to explain everything. You have to explain everything with a working note, everything. So in the second case, the final answer is see 300 and 600. 300 is a replacement cost and 600 in case of finished goods is a net realizable value, guys. Okay, there are many other questions. Please go through all the questions at least once. It will help you a lot in the exam. Okay, and we'll move on to AS3 now. Accounting Standard 3 Cash Flow Statement. This is a separate chapter also in your accounting subject, and many a times a full question also comes on AS3. However, many a times also in first 20 marks question, which is for AS, they ask a 5 marks question on AS3. We'll be discussing few important aspects. You are aware already, I am sure you have already done this. The cash flow statements is an additional disclosure which is made in the financial statements. It is applicable only to certain entities, not to all. So I'll request you to go through the applicability of AS3 once. And in the cash flow statement, we are presenting a statement of how much cash comes in, how much cash is cash inflow is there, how much cash outflow is there, and we are dividing this all the cash flows into 3 activities. And we are talking, when we say cash, we are also including cash equivalents as well. So first we will be focusing our attention on the definition of cash and cash equivalents. Cash means obviously cash in hand, and demand deposit with banks. Demand deposit means whenever you demand, bank will immediately give you the money. That is a demand deposit. And what is a cash equivalent? Cash equivalent includes short-term highly liquid investments, first one, that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. There are various government securities which are very short-term, commercial papers, etc., etc. Many securities are there. So these are short-term, highly liquid. Highly liquid means I want money, I get immediately, maybe 1 or 2 days max, I get the money. That is highly liquid. And that are readily convertible means immediately there is a market available for that. Whenever you want, you can liquidate it, you can convert it into cash. That is, we consider that as a cash equivalent. Similarly, securities with a short-term maturity, and very important, 3 months. Short-term maturity means 3 months period or less from the date of act. Suppose if certain securities are acquired, the maturity period is 3 months or less, you can consider that as a cash equivalent. Sir, what about investment in equity shares? There is a clarification on that. Investment in shares are not normally taken as cash equivalent because of the uncertainties associated with them as to realizable value. We know that the share market goes up and down, it goes on and on. It is highly volatile. That's why there is a risk associated with the realizable value of the securities, and because owing to the prudence, owing to the fair presentation, we do not consider the equity shares of listed companies etc. because of the volatility, because of the uncertainties about the realizable value. We do not include them in the cash or cash equivalents. So they might ask you a question on what is a cash and cash equivalent, guys. In that case, if there are short-term highly liquid investments which are readily convertible, which can be readily be converted to cash, consider them. If there are securities with the maturity of less than 3 months, consider them. But if the maturity is more than 3 months, do not consider them. And shares, equity shares investments, do not consider because of the volatility risk associated with that. Okay, we'll take up one question as to the what are the cash and cash equivalents and what are the cash flows, guys. Cash flows are either inflows, that is receipts, or payments of cash and cash equivalents. Cash flows arise when the net effect of the transaction is to either increase or decrease the amount of cash and cash equivalents. For example, net effect, there is a reduction in the accounts receivable. There is a reduction in the accounts receivable. Accounts receivable reduce, that means the net effect is your cash balance increases because that much more you have realized. So your cash balance increases naturally. Okay, so for increase and decrease in assets and liabilities, there is one rule which we used to tell, which my actually cousin brother who takes classes in Mumbai, so he used to tell the BCom students two formulas. He used to say, I love Dev Anand and don't love Ila Arun. Was one singer, old singer, I do not even know, but that was a known name, Ila Arun. You, instead of Ila Arun, you can take anything. Don't love IA Isha Ambani. Oh, I'm not saying that, I'm just saying for a formula. So he said, means this is not how the CS students remember. I'm just telling you, I'm just taking 1 minute for this. I love Devanand means increase in liabilities. First formula, increase in liabilities, decrease in assets. Increase in liabilities, decrease in assets. And love is a positive, so cash inflow. That means if there is an increase in liability, current liability, that is a cash inflow, and decrease in asset or current asset, that is a cash outflow. Second was, he says, don't love Ila Arun, decrease in liabilities, increase in assets, but don't love negative cash outflow. That's how he used to tell the BCom students. However, in this formula, there is one problem. As an auditor, I could trace it. The problem is that when we say love, I love Devanand, and love, we are saying it's a cash inflow, guys. It would depend on whether it's a male or a female. For males, I believe, how a love is a cash inflow, it's most likely to be cash outflow. But no, that's not how we remember it. That means we take it as a love is a positive thing, and that's why it's a cash inflow. That's how he used to tell. But guys, we are expert, I know, so हमको ये करने की ज़रूरत नहीं है. Anyway, then third is, any transaction which does not result in cash flow should not be reported in cash flow statement. For example, if there is an exchange of asset, means if the asset has been acquired for which equity shares have been issued, then is it involving any cash flow? No. Then that need not be reported in the cash flow statement. And movements within cash or cash equivalents are not cash flow. Obviously, cash would run from bank. Actually cash in hand balance increases, bank balance reduces, or vice versa. Those transactions is only a change within the cash equivalents that need not be reported in the cash flow statement. We'll move on to What are the types of cash flows? We have classified them into three. First is operating activities, day-to-day business activities. Investing activities, we make the investments or sometimes we dispose of the investments. And financing activities, we raise the funds by various ways. Like for example, we raise the equity funds, we raise the loan funds. So that is financing activities. So we'll go in detail. Operating activities, these are the principal revenue generating activities of the enterprise. Principal revenue generating activities. For example, if I am a chartered accountant, a practicing chartered accountant, professional fees received, operating cash flow. Salaries, wages paid, day to, this is obviously, I pay salary not because I love employees, I pay salary because I have to pay it for, I have to run my profession. So that is also the operating activity cash outflow. So cash purchase, sale of goods, collection from customers, income taxes paid, payment to suppliers for goods or services, payment of salaries, wages, various business expenses, all these would be operating activities. Coming to the investing activities, these are the acquisition and disposal of long-term assets, guys, acquisition and disposal of long-term asset and other investments which are not included in cash equivalents. Obviously, if the investment is included in cash equivalent, so that is a cash equivalent, there is no cash inflow or outflow for that. But for example, they sell long-term asset which may be plant and machinery, which may be building, which may be even investment property and other investments, which may be a long-term, any long-term securities that you have obtained, all those investments. Any movement, the movement means if you dispose of the investment, there is a cash inflow. If you buy the investment, buy the assets, acquire the assets, there will be a cash outflow. Those would be covered under investing activities. Various examples we have considered here: receipts from disposal of fixed assets, loans given to or recovered from other entities other than loans by the finance. See, in case of financial enterprises, everything changes. If it's a financial enterprise like a bank or NBFCs, etc., then giving loan, taking loan, paying interest, receiving interest are ordinary activities for them, and all those activities will fall under operating activities for them. But if it's a non-financial entity like any manufacturing entity, any trading entity, any service sector other than banking and NBFCs, etc., would be for them receiving interest, giving interest, giving loan, taking loan would not be an operating activity. Of course, it may be investing activity, it may be financing activity, but it will not necessarily be a operating activity. Purchase of investment including brokerage paid, rent received on investment property, payment to acquire fixed assets, interest and dividend receipt. If interest is received, why do we receive interest? Because we have made an investment somewhere. Why do we receive dividend? Because we have made investment somewhere. That's why those cash inflows are investing activities, guys. Last is financing activities. I said, just remember one thing, everything changes for financial entities, financial enterprises which are involved with, for whom the giving loan, taking loan is a day-to-day business activities. For them, the rules change. Issue of shares or debentures for cash, because I am raising a finance. Now I am coming to the financing activities. Activities that result in change in the size and the composition of owner's capital, including preference share capital and borrowing of the enterprise. So wherever there is a change in the equity capital, there is a change in the owner's equity, owner's funds, own funds and loan funds, financing activities. Redemption of debentures, shares, payment of dividend and interest other than in case of financial enterprise. Payment of dividend, because you have raised money through shares, you have to pay dividend to shareholders. Payment of interest, because you have borrowed fund from the bank, you have to pay interest. So these would be financing activities. Underwriting commission paid, because underwriting commission is paid for raising equity capital. That's why this is also treated as financing activity. Cash credit means cash credit taken. It's like a loan taken, financing activities. Cash credit repayment would also be cash outflow under financing activities. A quick chart about the loans and advances given and interest on. Guys, as far as the loans and advances given, if the loans and advances are given to employees and loans and advances are given to the customers, then the things change a bit. Let's see one by one. Loans and advances given. First, financial enterprise and non-financial enterprise. See, for financial enterprise, loans and advances given are always operating. Then if it is given to subsidiaries, however, it is investing activities. Employees, suppliers, advance payment to suppliers and interest received all would be under operating activities, guys. But for non-financial enterprise, loans and advances given would ordinarily be investing activity. Subsidiaries also would be investing activity only when the loans are given to employees, because staff advances, employee advances is a normal feature of any business, that would be classified as operating activities. Any payments to supplier, advance payment to suppliers and interest, because they are supplier of goods. In the ordinary course of business, you may give an advance, not as a loan, just as a business advance, then that can be classified as operating activities even in case of non-financial enterprises. And interest received, earned from borrowers, etc., late payment etc., would be the from customers, not borrowers, from customers. And for financial enterprises, the customers means those who have borrowed the funds, so that would be an operating for non-financial. Okay, and I'll give you a simple rule. If it's a financial enterprise, then giving loan in the ordinary course of business, receiving interest in the ordinary course of business is operating activity. But if it's a non-financial enterprise, giving loan, receiving interest is not operating activity. Giving loan, receiving interest is investing activity. However, if the loan is given to employee or loan is given to supplier, then it could be classified as operating activity. Okay. Similarly, loans and advances taken and interest paid. For non-financial entity, loans and advances taken are always financial activity. Loans and advances taken even from subsidiaries is a financing activity. But if you are taking advance from a customer, it is operating activity. If you are paying late payment, you are paying interest for delayed payment to your suppliers, it is an operating activity. And where the inventory is taken as a part of inventory cost, very rarely, then AS is, but it's not very important. Let me ignore this aspect for now. And for financial enterprises, if you are taking a loan, if you are giving an advance, it is operating activity. If you are paying interest, it is operating activity. If you are taking loan, paying interest, ordinarily it is always operating activities for a financial enterprise. Okay, only if the loan is taken from subsidiary, then they say it is to be classified as financing activity, guys. What about income tax and TDS? Another favorite thing area of the examiners. See, what happens is we pay tax, and the tax is paid also on capital gains, tax is paid on interest income, tax is paid on rent income, and tax is also paid on the ordinary business profit. So the tax expense can be bifurcated into operating, investing, financing activities if you want to bifurcate that way. However, the cash outflows, because we make payment of advance tax and we do not bifurcate as to advance tax is paid for capital gain or this or that, and it is impracticable to bifurcate that. That's why AS gives a simple guidance. What AS says is you simply consider that as operating. Tax paid on operating income is operating cash outflows for all income. You consider that as operating cash flow. Income taxes paid will always be treated as operating activities. However, if there is a TDS against income, suppose there is an interest income and the TDS is there, then what do we do is, interest income is cash flow from investing activities. We will show gross interest as cash inflow and TDS as cash outflow. Only the TDS as cash outflow under that particular activity, investing activity. Similarly, if you are making payment of any expenses and you are deducting tax on it, again the same rule will apply. Means, suppose there are operating cash inflows, the expenses are operating expenses classified under operating activities, then obviously what we'll do is cash inflows of the concern, interest paid. For example, if there is an interest paid and there is a TDS on the same, then depending upon whether it's operating or it may be financing, accordingly it will be classified. Okay, coming to insurance claims received. One thing is very important, you have to treat them as extraordinary, and in a cash flow statement, guys, extraordinary cash inflows or outflows are to be disclosed separately. Extraordinary items are to be disclosed separately. Insurance claims received against loss of stock or loss of profit would be operating cash inflows, and insurance claims received against loss of property, plant, equipment, fixed asset would be investing cash inflows. But in both the cases, extraordinary cash inflows to be disclosed separately. We'll come to the format. Just we'll quickly go through the format. So let me put it. Cash flow from operating activities. There are two methods for operating activities. One is a direct method, one is indirect method. Under direct method, we shows directly all the cash receipts and cash payments. All the receipts from, you can go through this little quick. All the receipts from customers, from cash sales, payments for cash purchases, paid to suppliers, paid to employees, etc. Income taxes paid is shown separately, and extraordinary items are shown separately. Then investing activities, property, plant, equipment, purchase of investments, proceeds from investment, very important, interest received and dividend received. Then financing activities, share capital, proceeds, redemption, interest paid and dividend paid would come here. Then the total of all these three, sometimes there is cash inflow, net is cash inflow, we call it cash, net cash flow from this activity. If there is a cash outflow, net result is a cash outflow, we say net cash used in that particular activity, operating, investing or financing. And then opening plus cash inflows or outflows, we add them and we get the closing at the end of the period, the balance in cash and cash equivalent. But most commonly followed is indirect method, where we start with the net profit before tax and extraordinary items. We do adjustment for non-cash like depreciation, foreign exchange loss, and then interest, dividend, interest expense, because those would be classified under, not under operating activities but under either financing or investing. You get operating profit before working capital changes. Then here increase in liabilities, decrease in assets, or decrease in liabilities, increase in asset. That logic we apply for all the current assets as well as current liabilities. We get cash generated from operations. From that we deduct income taxes paid. We get cash flows before extraordinary items, just to show the extraordinary items separately. And this is indirect method only for operating activities, guys. Financing, investing activities are all the same. Guys, you have to practice the preparation of cash flow statement. There is a full chapter also on this, and the question is likely on the full question is also likely, but a question on accounting standard is also very much likely. I'll be taking two questions, guys, question number 3 and question number 6. Other questions you may do on your own. Little quick, let us take question number 3. Following is the cash flow abstract. Cash flow abstract is given, opening cash is given, various cash inflows and outflows are given to you, and the closing cash and cash balance is given. This question is a study material question, and also it has been asked in the mock test paper of April 21 as well. Let's analyze this. Opening cash and cash equivalent, you know where to write. Cash and bank balance. Share issued. Share capital, shares issued 5 lakh rupees you have realized. Obviously it will go under financing activity. Collection on account of trade receivables would go under operating activity. Sale of fixed assets, where it will go? Proceeds from sale of fixed assets will go under investing activities. Then payment for accounts payable would be operating. salaries and wages would be operating, payment of overheads would be operating activities, fixed asset acquired 4 lakh, fixed asset acquired would be obviously investing activities, debentures redeemed, redemption of debentures would be financing activity, bank loan repayment 2,50,000, loan financing activity, taxation we know where to deduct, operating activity, dividend 1 lakh outflow, that there is an outflow of the dividend which is to be shown under financing activity. That's it, and the cash flow is to be presented in this manner in the standard format, and it should tally, it will tally, it is tallied, rather the receipt and payment means the cash flow extract itself is given to you, becomes way too easy. If the P&L balance sheet is given to you and then you have to prepare a cash flow statement, you have to be very careful in every adjustment that you make. So this is the answer, guys. Income taxes paid are deducted here, purchase sale of fixed asset here, and under financing activities, share capital, bank loan, debentures redeemed and dividend paid, and it has to tally. 15,000 cash and cash equivalent at the end of the period. Here the total is 15,000. The opening is 80,000. 80,000 is the opening. Okay, let's go to question number 6. This is again a mock test paper as well as ICAI study material question. From the following information of XYZ Limited, calculate the cash and cash equivalent as on 31st March. Okay, first, balance as per the bank statement 25,000. Second, check issued but not presented in the bank 15,000. Third, short-term investment in liquid equity shares of ABC Limited. Fourth, fixed deposit created on 1st November and maturing on 15th of April. Then, short-term investment in highly liquid sovereign debt mutual fund having maturity period of less than 3 months. And then, bank balance in foreign currency account in India. And the bank balance is 1,000 US dollars, and the conversion rate is on the day of the deposit it's 69 rupees, and on the closing reporting date it is 70 rupees per US dollar. So what you are being asked to do, calculate cash and cash equivalents, guys. Now you have a balance in the bank account 25,000, but you have issued the checks 15,000 not presented in the bank. But you have already issued the checks, guys. The checks will sit in the reconciliation statement, but in your books of account, because you have issued the check, your bank balance will reduce by that amount. So 25,000 minus 15,000, 10,000 would come under cash and cash equivalents, guys. Second, short-term investment in liquid equity shares of ABC Limited. As I already told you, because of the risk associated, we do not consider the equity shares. That's why this will not be considered in the cash and cash equivalents. Fixed deposit 75,000 created on 1st of November, maturing on 15th of April. So from November you start counting November, December, Jan, Feb, March. So it is beyond the 3 months. That's why this also will not be considered as cash equivalent. Then short-term highly liquid investment having a maturity period of less than 3 months, yes, it would be considered in the cash and cash equivalent. And then last, the foreign currency bank account balance 1,000 will be cash equivalent, but 70 rupees rate will be used because this is a closing rate that you will use for this. Same as the AS11 says, the monetary items you use the closing rate, the same logic will be used. So these 3 items would only fall under the cash and cash equivalent, guys. Okay, this ends our discussion on AS3. Other questions, please do them, and obviously the full questions you already have practiced, that will help you a lot. This won't be a problem, AS3 won't be a problem for you, I believe. Okay, now we will move on to AS10. AS10, property, plant and equipment, guys. Now I have already shared a full video on AS10 on already my YouTube channel is there. It is recorded in 3 sessions along with questions and answers. However, I'm trying to cover almost all important aspects of AS10 in the very short period of time. So I'm not going into the history. Earlier there were two accounting standards, now the depreciation also has been included in AS10 and all. I'll straight away come to this. Earlier it was fixed assets, now it has been renamed as property, plant and equipment, and rightly so. And also the principles relating to the depreciation have also been incorporated in this standard itself. That's why AS6 is not there anymore. Okay, so we'll go one by one. We'll first see the definition of property, plant and equipment. Property, plant and equipment means all tangible items, obviously. So this applies only to tangible items. For intangible assets there is a separate accounting standard 26, which tangible items which are held for first use in the production or supply of goods or services, for rental to others, and for administrative purposes. Because of this definition, you can see that all plant and machinery, factory building, office equipments, delivery vehicles, all the assets which are even used for administrative purposes, firefighting equipments, all those for rental to others, even investment properties, because you are giving them on rent, etc., also would be covered under the property, plant and equipment. Under AS13 also it specifically says that investment properties are to be recognized in accordance with AS10. So all these assets would be covered, all tangible items which are held for these purposes and which are expected to be used for more than a period of 12 months. Because if for they are expected to be used for a short term period, we expense it off to the profit and loss account. Only if they are expected to be used for a period of more than 12 months, we do recognize them as property, plant and equipment, guys. Okay, very simple, straightforward definition. AS is not applicable to first biological asset. By biological asset we mean animals and plants, trees. Okay, biological assets related to agricultural activity, specifically says biological assets related to agricultural activity are excluded from the scope of AS10. However, only it says other than bearer plants, other than bearer plants. So if it's a bearer plant, then AS10 is applicable. But other than bearer plant, for any biological asset like a livestock, like any other plant, AS10 is not applicable. And AS10 is also not applicable for wasting assets, including mineral rights, expenditure incurred for exploration, etc., etc. Wasting assets is simple word you remember. Okay, but what is a bearer plant? What is a biological asset? Biological asset includes living animals and plants. If living animals are related to agricultural activity, AS10 is not applicable. If living animals are not related to agricultural activity, then if the definition is met, AS10 is applicable. I'm not going into detail aspect of this, but mostly the livestock is related to agricultural activity and AS10 is not applicable. However, if the living animals are not related to agricultural activity, like for example horses are used in racing, etc., then AS10, if the definition is met, definition means held for these purposes and expected to be used for more than 12 months, then AS10 is applicable. Obviously, when you go to Ind AS, which you will be studying at CA final level, there is a separate Ind AS for agriculture, and in that case the principles are clearly given for how this livestock accounting is to be done. But right now remember this thing, livestock AS10 is not applicable. Mostly livestock relates to the agricultural activity. And plants, if there are bearer plants, AS10 is applicable, but for other plants AS10 is not applicable. What is a bearer plant? I'll give you a simple example. If it's a mango tree, then it bears fruits, and fruit is an agricultural produce, and it bears fruit for more than 12 months, because usually it has a life of, let's say, 20 years. So 20 years you are getting a fruit, then the bearer plant is, yes, it is a property, plant and equipment, and the principles of AS10 would apply. However, if it's a simple, like for example rice, if it's a paddy, means a crop which is annually it is cut, it's, if for example any crop for that matter, sugarcane is not bearer plant, because the plant, it's a standing crop, it is cut and sold. It is sold itself as an agricultural produce. Mango tree is not sold as an agricultural produce, mango fruits are sold. This is a difference. So bearer plant is a plant that satisfies three conditions. Number one, it is used in production or supply of agricultural produce. Number two, it is expected to bear produce for more than 12 months. And third, has a remote likelihood of being sold as agricultural produce. Remote likelihood of being sold means a plant itself is never sold as a agricultural produce. However, suppose a mango tree gets old, now it is not bearing fruits anymore, let's say after 25 years, you cut and sell it as a scrap, that is okay. It has a remote likelihood of being sold. That is not, mango tree is not grown for the purpose of selling it as a timber, correct? But if it's a teak wood, then the tree itself is cut and sold. There is a very high likelihood of that tree itself being sold as agricultural produce. Then it is not a bearer plant. So the following are not bearer plants. First, trees grown for use as a lumber or means wood, for example. Then trees which are cultivated both for their fruit as well as their wood, and annual crops are not bearer plants. For recognizing a property, plant and equipment, first of all, it should fall within the definition of PP. What is the definition? It's a tangible item held for production or administrative purposes, etc., and used for more than 12 months. This is one basic thing. Second, it cannot be a livestock. It cannot be a wasting asset. It cannot be a plant other than bearer plant. Okay. Once that is done, what is the recognition criteria? You can recognize if the two conditions are satisfied. Number one, it is probable that the future economic benefits associated with the item will flow to the end. Very important. If you are recognizing a particular item as an asset or PPE, then you should know that there will be future economic benefits. Either economic benefits by way of producing goods and selling them, or economic benefits by way of saving in costs, or economic benefits which may not be necessarily directly countable in terms of the sales and profit, but there are economic benefits, and it is probable, there is a probability that there are economic benefits associated with these. And second, the cost of the item can be measured reliably. There has to be a reliable measure of the cost. If the both conditions are satisfied, then recognize as an PPE. It may be appropriate to aggregate individually insignificant items, molds, tools. Instead of classifying so you have 100 molds, you can club them together for convenience. You have to consider materiality. Very small items like calculators, etc., are never recognized as PPE. And spare parts, standby equipments and servicing equipments, if they meet the definition of PPE, recognize. Otherwise, you can classify them as inventory. See, what happens is sometimes certain consumables, etc., which rotate on a routine basis are classified as inventory, but otherwise they meet the definition criteria, they meet the recognition criteria, they are classified as property, plant and equipment. What about subsequent costs? This is a very important aspect. What we actually do under revised AS10 property, plant and equipment is, we do not recognize asset as one asset. Rather, we recognize the various components of the asset. For example, if you want to recognize a car as an asset, as a property, plant and equipment, then tires will be recognized separately. The seats and upholstery will be recognized separately. Engine may be recognized separately. Other accessories like the lights, etc., will be recognized separately. The body will be recognized separately. If there are certain fiber parts attached to it, those parts may be recognized separately. This is what we call componentization of the property, plant and equipment. We recognize each and every component separately. Not only this, but if the suppose car requires overhauling after every 5 years, or major inspection, major maintenance, overhauling after say every 5 years or 7 years, that also we recognize as a separate item of the car. Sir, but when we pay for the car, we pay for the entire car. Like for example, we bought a car for let's say 20 lakh rupees, we pay 20 lakh rupees. Yes, but while recognizing, you evaluate tires separately. If there is a car, a music system installed, that is you evaluate separately, accessories separately, body separately, engine. This is called as identifying various components. Not only that, but you assume that suppose today if we do the overhauling of the car, then we might have to spend say 2 lakh rupees, then 2 lakh as a separate element of cost, and then the remaining things means significant items, significant components you identify, and you can remaining things you can call that as a rest of the car. Okay, that is very interesting. That is AS10. Now subsequently, when you replace a part, suppose you have recognized the tires and you are estimating a life say 3 years, and after 3 years you will replace the tires. So subsequently when you replace them, the old tires will be de-recognized and the new tires will be recognized and will be depreciated another for a period of 3 years. However, the total depreciable period cannot exceed the life of the car itself. Okay, so these are the principles. So for subsequent cost also we see whether the recognition criteria is met or not. Whether the recognition criteria is met or not. So if you replace the engine oil, then you do not recognize it as a PP because it's a day-to-day maintenance expenditure. It's a routine, regular kind of a maintenance expenditure. So if it's a day-to-day servicing like labor, consumable, spare parts, we recognize that in the profit and loss account. However, if it's a replacement, and replacement at regular, let's say 3 years, 5 years, it requires a replacement, then we recognize that as a separate item of PP and de-recognize the old one. And if it's a regular major inspection, say after 7 years overhauling is to be done, major overhauling is to be done, then that time we will de-recognize that component of overhauling cost which we have already recognized earlier. We'll de-recognize that and recognize the new as a separate component. For example, a ship, this especially happens in case of ships, they require major overhauling, let's say after 7 years. Then that component will depreciate over 7 years. Practically, this is little difficult to actually implement. Practically, yes, it is little difficult to implement. But as a student, there is no more very complications are not many. Simple questions are usually asked in exams. How you measure a PP? Initial recognition is always at cost. Initially, when you recognize the PP for the first time, you always recognize it at a cost, and subsequently you can follow either cost model or revaluation model. An enterprise should apply this policy, means this should be the policy. Once you apply a revaluation model, you should apply the revaluation model for the entire class of property, plant and equipment. What is a class? Class is a grouping of the similar assets of a similar nature and use. For example, plant and machinery may be one class, factory buildings may be one class, office equipments is another class, delivery vehicles is another class, vehicles for the purpose of the employees, buses, etc. may be another class. Furniture and fixtures may be another class of PP. Class would depend upon the grouping of similar nature and use. It will depend upon nature and use. If they are used for same purpose and the nature is also same, you can classify them as one class. And once you have classified that as one class, for the entire class you have to either apply cost model or revaluation model subsequently, guys. Either cost model or revaluation model subsequently. You cannot, there is one class of PP, there are 10 assets, for few assets you apply cost model, for few assets you apply revaluation model, is not allowed. However, there are two classes, for one class of PP you apply cost model, for another class of PP you apply revaluation model is allowed. We'll take one question on how to actually identify class of PP, whether the assets fall in the same class or not. For that we'll be taking up one question. Now when we are talking about a cost, we have to this very important aspect is what is to be included in the cost of PP and what is not to be included in the cost of the PP. Cost would include purchase cost, all non-refundable taxes, directly attributable cost like freight to bring the asset. If suppose you are doing some inspection, certain trial runs, a certain installation, commissioning, erection, all those costs would be included. Decommissioning, restoration and similar liabilities. This aspect most of the students find it a little difficult. For example, if uh, because you are acquiring an asset, after its use there is a restoration liability. There is a restoration liability. For example, your asset is let's say a tower, mobile tower, and after certain years you have to restore the land, or suppose it's constructed on the building, you have to do some restoration work, and in that case that is a liability, that is a contractual liability, or it may be a legal liability, and you have to make a provision for that liability today itself. The provision is done as per AS 19, except that it is discounted at present value. At present value it is done. Usually for any other provision we do not do this discounting, but for this we do it. And annually interest cost is recognized separately, and the provision is recognized means the entry is PP account debit to this provision for decommissioning, restoration and similar liabilities. So that provision, that liability is also included in the cost. It is debited to PPE. That means it is included in the cost of the PPE itself. However, cost of opening a new facility. You open a new facility, inauguration, you celebrate the inauguration party, you introduce a new product, you do a certain marketing, you do staff training. These costs are never included. Administrative and other general overheads are never included. Initial operating losses means you start a business entity initially, because the production is low, the demand is low, the market is new to you, there may be certain operating losses. You cannot capitalize those operating losses into the PPE. Prudence, understand this. Cost of relocating, reorganizing the part or all operations of an enterprise. For example, you have to shift your plant and machinery from one site to another site. You have to relocate, and you have to knock it down, dismantle, take it to another site and restructure it or reorganize there. All those costs, because you are adding no new asset, all those costs are to be charged to profit and loss account and are not to be recognized as PPE, or not to be added to the cost of PPE. Cost incurred when the asset is operated at less than full capacity. There is one question in the module also. We have covered this in the PDF. The question says that there is an opening of an amusement park. However, because certain things are not yet operational, it is operating, and it's like a trial run or a soft opening. Open for public, not a trial run, sorry, open for public, but it's a soft opening, means not operating at full capacity, only 20% capacity we have opened and started with. Even in that case, those costs for operating at less than capacity cannot be capitalized. Those are to be charged to the profit and loss account, guys. Okay. Then on revaluation, how do we treat it? Revaluation possibly is, there are two possibilities. On revaluation, there is increase in the value or there is a decrease in the value. Okay, revaluation means after every interval, say 3 years, 5 years, etc., we review the value and we do state the asset at fair value. Okay, so there are two possibilities, increase or decrease, but there are actually 4 possibilities. There might be an increase and subsequently there might be an again increase. There might be a initially decrease and subsequently increase, or there might be a decrease in the value and subsequently again there is a decrease. But it is also possible that there is earlier increased and afterwards there is a decrease. So with all these permutations and combinations will be covered in this one chart. Suppose there is an increase in the value, the increase should be credited to revaluation surplus. Guys, we do not credit it to profit and loss account, we credit it to revaluation surplus. And subsequent, if there is increase, subsequent increase, earlier also increase, subsequent increase, same thing will happen again, it will go to revaluation surplus. But earlier decrease, पहले decrease हुआ बाद में increase हुआ. Okay, first decrease and then increase, then what do we do is we recognize in P&L to the extent of reversal of earlier decrease. Means when earlier it was decreased, you have taken it to profit and loss account, you have debited profit and loss account. To that extent, you can credit it to profit and loss account, and afterwards, if there is still further increase, then that is to be transferred to revaluation surplus. Very simple logic. First, if something has happened and it is reversing, reverse to that extent, and beyond that you take to revaluation surplus. If it's a decrease, we will always charge. See, again the prudence. Decrease is charged to profit and loss account, but increase is credited to separate account called revaluation surplus. Obviously, it's still reserves and surplus, but it does not go to profit and loss account of the current year. And subsequently, if it is decrease, means first increase and then decrease, if this happens, then we can debit directly to the revaluation surplus to the extent existing credit balance, because earlier it was credited to revaluation surplus. To that extent, you can debit it to revaluation surplus, and if there is further decrease in value, you can debit it to profit, and you have to debit it to profit and loss account once revaluation surplus of that particular item of PPE is exhausted. Guys, this is very complicated. Again, practically I'm saying, because this needs to be maintained. All these details, this PPE register needs to be maintained for all items of PPE, and this is to be individually checked as to every item of an asset, whether there is increase in value, decrease in value, and so on. Guys, very complicated. Practically means involves a lot of tracking. Okay, then how the carrying amount is adjusted, this is, understand this, revaluation happens means your book value, carrying amount means book value or written down value. In simple words, carrying amount either increases or decreases. But how the presentation is done in the financial statements, we'll take one example. For example, understand this, asset with a carrying amount of 600, that means book value is 600. The gross amount means original cost is 1000 and accumulated depreciation is 400. Now you revalue that 1500, means 600 becomes 1500. That means net gain is 900. Means you can add lakhs, thousands, whatever. How you will do it? First method is, understand this, 600 becomes 1500. 600 becomes 1500. So we will increase cost as well as accumulated depreciation proportionately. Both we will increase proportionately. So how I'll do it? 1000 is my original gross amount. 1000 into 1000 into my revised value is 1500 and original value is 600. It becomes 2500. So this will be 2500. Accumulated depreciation, same rule. Original 400 proportionately increase 1500 upon 600. 400 into 1500 divided by 600, 1000. And the carrying amount automatically becomes 1500. Revise. Okay, the journal entry would be PP account debit 1500, because from 1000 it becomes 2500. Accumulated depreciation from 400 it becomes 1000, so accumulated depreciation credit 600 and revaluation surplus 900. This would be the journal entry. 900 would go to revaluation surplus. This is method 1. In method 2, we'll eliminate the accumulated depreciation first. So currently what we have is 1000 minus 400, we have 600, correct? So we have 400 accumulated depreciation. We'll reverse it entirely. So accumulated depreciation we have debited, but I want total 900 increase in value. 400 is accumulated depreciation, I reversed it, and remaining 500 I'll debit separately to PPE account, and entire 900 will be revaluation surplus. In both the cases, guys, revaluation surplus would be the same, but the presentation would now be 1500 minus accumulated depreciation nil and carrying amount 1500, and here the presentation was different. So only it is a matter of presentation. Journal entries accordingly can be, you can see them, but focus on this versus this. But in both the case, the amount that goes to revaluation surplus is 900. Okay. What are the principles relating to depreciation? Few important principles we'll discuss first. Component method of depreciation. Every component is depreciated separately over its useful life. However, estimated useful life of any component cannot exceed the estimated useful life of the asset itself. Recognize depreciation is to be recognized in profit and loss account unless it is included in the carrying, means sometimes the depreciation is capitalized by virtue of AS 2 or 26, otherwise the accounting treatment is take it to profit and loss account. But this is not important, guys. Ye means, for example, if it's a production overhead, a part of it automatically goes to the finished goods inventory. That's how it is not recognized in profit and loss account. That's what AS says. But obviously you debit it to P&L account itself always. The depreciable amount of an asset shall be allocated on a systematic basis over its useful life. Depreciable amount is cost depreciable amount is equal to cost minus cost or revalued amount minus RV, here is residual value. Okay, residual value. Okay, cost minus residual value, or if it's a revalued amount, it's a revalued amount minus residual value. Depreciation begins when the asset is available for use. Guys, under Income Tax Act, they say asset is put to use. We are not concerned with that. Asset is available means it's ready for its intended use. You can now use it. Whether you actually start using it or not, it is available for use. Depreciation starts. Periodic review of residual value and useful life is to be done, and if there is any change, it is recorded as change in accounting estimate. It is recorded as change in accounting estimate, guys. Okay. For depreciation, you can either use a straight line method or WDV method or units of output, means the life is expressed. For example, for a mold, they say the life is 1 lakh units. Then in the first year, you have already used 40,000 units you have produced on the mold, 40% you depreciate. This is a units of production method. Depreciation method is to be reviewed at least each financial year end. Change in the method is accounted for as a change in accounting estimate. Okay, A standard makes it very, very clear, guys. About land and building, two very simple principles. They are separate assets. Most of the students think that land and building can be clubbed together. No. Even if you have bought the land and building together, entity has bought the land and building together, land is to be recognized as a separate asset, building is to be recognized as a separate asset. Land is not depreciable, building is depreciable, because land has unlimited life and building has a limited life. Compensation for impairment, I'll tell you in brief. It may so happen, actually impairment has been explained in AS 28, which is not in your syllabus, so I will not focus much on that, but I'll tell you one thing. Suppose there is a damage of the asset by anything, asset is damaged, destroyed, and you get an insurance claim. The logic here is that first, these are separate events, means impairment of the asset or damage or destruction of the asset is a separate event. For that you recognize a separate means you make a separate entry for derecognition. For derecognition you make a separate entry, number one. Number two, maybe you will receive insurance claim, that is a separate transaction. If the claim is receivable and it can be accounted, it can be recognized as a claim receivable as per accounting principles, you recognize that. Third, you may acquire from that money that you have received from insurance company, you may add your own money and you may acquire a new asset. Then that is altogether a separate transaction. That means suppose the asset is destroyed by fire, you receive insurance claim and you acquire a new asset, you will make three separate transaction entries. One for derecognition of the asset, second for receipt of the insurance claim or insurance claim receivable, and third for acquiring new asset, and the new asset will be depreciated over its useful life. So few questions and answers, there are many questions and answers I have given. Even ICAI has done a phenomenal job, guys. Believe me, those who are on a self-study module, means those who have not joined any classes, the best way to study is your ICAI module. I do not even claim use my notes or something. My notes, my questions and answers, first I have taken all the ICAI module questions and then I selected questions from RTP, mock test papers, suggested answers afterwards. But first I have taken all the questions from ICAI module and ICAI practice questions, guys. Module is fantastic, believe me. Yes, there are some minor modifications which are required, etc., but believe me, institute has done a phenomenal job. You can refer to the module if you want. If there is any doubt, best recourse is to refer to the ICI module. Guys, without wasting much time, let me go to the questions. Few selected questions we'll discuss. First, we'll take question number 5. Omega Limited contracted with a supplier to purchase machinery which is to be installed in its one department in 3 months. Special foundations were required for the machinery which were to be prepared within this supply lead time. The cost of the site preparation and laying foundation were 1,40,000 rupees. These activities were supervised by a technician during the entire period who is employed for the purpose of rupees 45,000 per month. The machine was purchased at rupees 1,76,96,000 including IGST of 12%. So an ITC is available. 1,79,60,000 includes IGST of 12%. So I'll do into 100 by 112. 1,76,960,000 into 100 divided by 112. 1,58 lakh is a net price. Fine. And 50,000 transportation, etc. An architect was appointed at a fee of rupees 30,000 to supervise the machinery installation. You are required to ascertain the amount at which the machinery should be capitalized. Guys, in the machinery capitalization, these 1,58 lakhs would be included. Then site preparation and foundation, because it is essential for the machinery to make it ready for the intended use. It will be included 1,40,000. Then a technician's whatever 3 months salary would be included. Then 50,000 transportation charges also would be included, and then these 30,000 fees also would be included. So let's have a look at the answer, guys. Purchase price net of GST, because we are assuming that ITC has been availed. Site preparation cost, technician salary 3 months, transportation, professional fees, and this would be the total cost of the machinery, guys. Then next I have selected question number 10. Let me go to question number 10. Entity A is a large manufacturing group. It owns a number of industrial buildings such as factories and warehouses and office buildings in the several capital cities. The industrial buildings are located in industrial zones, whereas the office buildings are in the central business districts of the cities. Entities A's management wants to apply revaluation model to the subsequent measurement of the office buildings, but continue to apply the historical cost model to the industrial buildings. State whether this is acceptable under AS10. What AS10 says is, the subsequent recognition method, either cost model or revaluation model, is to be applied to an entire class of PPE. So if office building and industrial buildings are two separate classes of office, just a sec. If office buildings and industrial buildings are two separate classes of PPE, then this is acceptable. If they are same class of PP, this is not acceptable. So first, is their nature the same and is their use the same? Understand this. Their nature is also different, because one is factory industrial buildings, one is office building. Nature is different because the location is also different, and second, use is also different, because industrial buildings are necessarily used for manufacturing or as a warehouse, and office buildings are used for administrative purposes. That's why these two can be classified. Let's read the answer. As a separate class, entities A's management can apply the revaluation model only to the office buildings. The office buildings can be clearly distinguished from the industrial buildings in terms of their function, nature, and general location. The different characteristics of office buildings enable them to be classified as different PPE classes. The different measurement models can therefore be applied. Very simple. If these are two separate classes of PPE, which yes, because the nature use is different. Let's go to question number 12. Entity A purchased an asset on 1st Jan for 1 lakh rupees and the asset had an estimated useful life for 10 years. A residual value is nil. On 1st January 2017 means 1 lakh, life is 10 years. Suppose the straight line method is given. Yes, straight line is given. So every year, because residual value is nil, every year depreciation is 10,000 rupees. 13, 14, 15, 16. For 4 years, 40,000 depreciation has been charged, and on 1st January 17, the directors review the estimated life and decide that the asset will probably be useful for further 4 years. Means originally it was estimated to be useful for 10 years. After 4 years, now they believe that only now 4 years are remaining. So what happens now? Very easy. You have already depreciated 40,000 rupees. That means your carrying amount is 60,000. 1 lakh minus 40,000. 60,000 you will depreciate for further 4 years. So now you will provide depreciation of 15,000 every year. As simple as that, guys. This is module question as well as RTP question. We'll quickly go through the answer. First 10,000. So your now value is 60,000. Now 60,000 divided by 4, 15,000. As simple as that. Let's go to question number 16. Entity A carried plant and machinery in its books at rupees 2 lakh rupees. These were destroyed in a fire. The assets were insured new for old and were replaced by the insurance company with the new machines that cost rupees 20 lakhs. The machines were acquired by the insurance company and the company did not receive the 20 lakh rupees as cash compensation. You did not get a cash compensation. Machines were replaced. State how the entity A should account for them. Very easy. The entity first should account for a loss on derecognition of the original carrying plant and machinery. Okay. The entity should separately recognize a receivable and a gain in the income statement from the insurance proceeds under AS 29 once the receipt is virtually certain. This is AS 29. You can avoid this part. The receivable should be measured at the fair value of the asset that will be provided by the insurer. So basically, if we are talking about the journal entries, there will be 2 journal entries. First, you will recognize this 2 lakh as a loss. Means 2 lakh will go to profit and loss account. Machinery account will be credited, or will debit loss on machinery and machinery will be credited. So this will be nullified, and this loss on machinery, sorry, let me write it properly. Loss on machinery, loss on derecognition of machinery will go to P&L account 2 lakh rupees. And this 20 lakh will be recognized as separate PP. Suppose 20 lakh is the fair value, then the PP 20 lakh would be debited, and obviously profit and loss means income or insurance claim income 20 lakh will be credited in this case, guys. This is how it will be accounted for. Yes, this will be shown as an extraordinary item separately. Then question number 17. With reference to AS 10, classify the items under the following heads. 3 heads are given. Very nice question. 3 heads are given. First, purchase price of plant means whatever will be charged in the invoice. Purchase price means it will include taxes, etc., which are charged in the invoice. Then directly attributable cost means freight, insurance, etc., etc., and cost not included in determining the carrying amount of PPE. You have to classify everything. First, import duties and non-refundable purchase taxes will go under 1. Okay, because it will be included in the purchase price itself. Initial delivery and handling cost, directly attributable cost. Initial operating losses will not be included, so under 3. Then cost incurred while item of capable of operated by the management at less than full capacity, 3, it will not be included. Then trade discount and rebates invoice में ही जाएगा 1, it will be reduced from the invoice price itself. Cost of relocating etc. will not be recognized as a cost of PP, 3. Installation and assembly cost directly attributable. Administration and general overheads, 3 not included. Cost of testing whether the asset is functioning properly after deducting the net proceeds etc. directly attributable. Cost of conducting business in a new location including staff training not included, and cost of opening a new facility not included. Guys, this will help you understand many questions which cost is to be included in the cost of PPE. All directly attributable costs, if you are constructing an asset on your own, then all directly attributable costs are also to be included. Sometimes they give a question that you are remodeling or renovating something. In that case, if the salaries and wages are of the nature of the operating expenses, then those are not to be included. But the salaries and wages are of such nature that the employees are actually working on the project itself, on the construction installation activity itself, then their salaries or that part of the salaries would be included as a directly attributable cost. Then question number 18. ABC Limited is installing a new plant at its production facility. It has incurred these costs. Please provide cost that can be capitalized. Cost of the plant, suppliers invoice plus taxes, yes, it will be capitalized. Initial delivery and handling cost will be capitalized. Cost of site preparation will be capitalized. Consultants used for advice will be capitalized. Interest charges paid to the plant, deferred credit will not be capitalized because plant is ready to use. We can assume that it is ready for use whenever it is we have bought it, so it's not a qualifying asset, so interest cost will not be capitalized. Interest cost will be capitalized only if it's a qualifying assets within the meaning of AS 16. Then estimated dismantling cost to be incurred after 7 years, yes, it will be capitalized because it's decommissioning, restoration or similar liabilities. So that's why this also will be capitalized, and operating losses will not be capitalized. Next question number 21. But please go through all the questions because it will help you a lot. ABC Limited is setting up a new refinery outside the city limits. In order to facilitate the construction of the refinery and its operations, ABC Limited is required to incur expenditure on the construction or development of a railway siding, road and bridge. Please understand this. Railway siding, road and bridge का construction आप कर रहे हो. Though ABC Limited incurs the expenditure on the construction or development, it will not have the ownership rights on these items, and they are also available for use to the other entities and public at large. Can ABC Limited capitalize the expenditure incurred as PP? Very nice question. See what the question says is, you are constructing a new refinery outside the city limits, and to facilitate the construction, you have to incur expenditure on railway siding, road and bridge. Railway siding means a space attached to the railheads for convenience, for transportation of materials, etc. So that you have constructed, and road and bridge also. However, as per the law, you cannot claim the ownership of railway siding, road and bridge. You will not be legal owners of these, and other people also may use the same railway siding, road or bridge which you have constructed. Should you capitalize the cost or not? The simple answer is yes, you should capitalize. Because is it a cost directly attributable to the construction of the refinery? The answer is yes. It is attributable to the construction of the refinery. Means refinery, in the refinery cost, you can capitalize it simply. You may not recognize it as a separate item of the PP, but you have to capitalize this. Secondly, even if the others may use it, is it still a cost which you have incurred? Yes. Substance over form, are you yourself going to use it? Let others use it, that is okay, but are you going to use it for the construction purpose of the refinery construction purpose? Is it going to facilitate your refinery construction project? Yes, and that is the reason why you should consider this as cost of PPE. Let's quickly go through the answer. Please read this answer, guys. Future economic benefits and measurement, both conditions if satisfied, you can yes. Then second important point is directly attributable to bringing the asset to the location and condition necessary for operating in the manner intended by the management. Now in the given case, what we are saying is it is apparent that the aforesaid expenditure is directly attributable, correct? And in view of this, even though the ABC may not be, and even though it's not a legal owner, did we not discuss substance over form? So even though ABC may not be able to recognize expenditure incurred on this asset as an individual item of PPC, it's okay. You may not be able to recognize because railway sidings will be used, and then after the construction project is complete, that will not give any other as a separate component. It's not that every 3 years, every 5 years you will have to recreate the railway sidings, etc. So it may not be recognized as an individual item of the property, plant and equipment, but because others also are using the same, but you can still recognize it as a basically as a refinery, as a this thing as cost of the refinery. Okay, not as a separate item. I did not tell you various components and rest of the refinery. The rest of the refinery also may be componentized into various components, but this railway siding will not be a separate component. It will be merged with the rest of the refinery, guys. Okay, please do all the questions of AS10 or read all the questions in my question bank. I have compiled around how many 21 questions are there. Please read all the questions before going ahead, guys. Let's, without wasting any time, let's go to AS11. Let's start with AS11. Effects of changes in foreign exchange rates. Now what happens is many entities do various transactions in foreign currencies. So for example, they may import the goods and the amount is to be paid in US dollars, or they are exporting goods and services, amount is receivable in US dollars, means the transaction is denominated in foreign currency. However, being an Indian entity, your currency is a rupees, Indian rupees, and even if you have to pay US dollars, what you have is Indian rupees. So what we do is, we'll go to authorized exchange dealer, we will give him Indian rupees, we will buy US dollars at the rate existing on that date, and then these US dollars will be transferred. Means this I am simplifying, actually it happens through bank and the money can be transferred, and there are various foreign currency accounts as well, but basically it happens this way, that you buy foreign currency by paying your own currency, Indian rupees, first thing. Second, in your books of accounts, you will record all the transactions in Indian rupees itself. You cannot have two reporting currencies. You will have only one reporting currency, and in India, which will be Indian rupees. So how to deal with when such transactions, when they are happening in foreign currency, they are denominated in foreign currency. Moreover, you may have a branch outside India in foreign country. You may have a branch in Europe. You may have a branch in Australia. You may have a branch in USA. Anywhere in the world, you may have a branch. And if you have such a branch, then the transactions that the branch is undertaking will not be in Indian rupees. Obviously, those transactions will be in foreign currency, maybe US dollars, maybe euro, maybe Australian dollars. Okay, so in your books of accounts, when you will incorporate the branch accounts in your own books, again you will have to use Indian rupees. So the question arises, at what rate you should convert those US dollars, because the trial balance of those foreign operations, foreign branches will be in different currency, and you will have to convert it in Indian rupees. As simple as that, guys. So all these aspects plus forward contracts as well, all these are dealt with by AS11, and we'll see a few important aspects of AS11. Foreign currency transaction is a transaction which is denominated in or requires settlement in foreign currency. Either it is denominated in foreign currency or it requires settlement in foreign currency. buying, selling, acquiring, disposing of assets, settling liabilities, borrowing, lending, all those transactions are included. Okay, before we actually see what accounting treatment is prescribed by AS 11, before that we should first see what is monetary item and what is non-monetary item, and a very easy and straightforward definition. Monetary items means money held and assets and liabilities to be received and paid in fixed or determinable amounts of money. Basically, bank balances, receivables and payables, accounts receivable, accounts payable, bank balances, sundry debtors, sundry creditors, bills receivable, bills payable, these are monetary assets. Other than these are non-monetary items like fixed assets, inventories, investment in equity shares. All these are non-monetary items, because treatment for non-monetary items in certain cases is different. We need to understand what is a monetary item and what is a non-monetary item. Now, how the foreign currency transactions are recognized is explained in simple diagram. In one diagram explains it all. We are not talking about foreign currency operation, means a foreign branch. We are not talking about a forward contract also. We are simply talking about a foreign currency transaction, like simple maybe import of goods and amount is paid later on, or maybe you have exported goods or services, amount is realized, received later on. Initial recognition is at the exchange rate which existed on the date of transaction. Initial recognition you have to do on a rate which is, we simply call it a spot rate. Spot rate is not a word used technically, but we can call it a spot rate, means a rate existing on the date of the transaction. Then subsequent recognition will depend upon whether it's a monetary item or whether it's a non-monetary item. If it's a monetary item, which is most likely in case of import, export, receivables, payables, is a monetary item. In that case, if reporting date comes in between, for example, I'll tell you, for example, if you entered into a transaction, let's say on 15th of Feb, and you settled the transaction, let's say on 10th of April, then initial recognition will happen on 15th of Feb on the date of exchange rate existing on that date. In between comes the 31st March, our reporting date. So for 31st March, again on a reporting date, you will use a closing rate, means a rate existed on 31st of March, and the difference between these two will be recognized either as exchange gain or loss, as the case may be. And then the transaction is settled on 10th of April. Again, the difference on 10th of April, when you actually pay, let me simplify this example. Suppose for example, on this, when you entered a transaction, rupee to dollar rate, let's say, was 70, you are making a payment, you are importing the goods. On 31st of March, it went up to 72 rupees per dollar, and when you actually paid on 10th of April, let's say it was 73 rupees per dollar, and let's, for the sake of simplicity, assume that the transaction is for $1. In that case, you will first recognize the transaction at 70 rupees. Means, suppose it's an import purchase, you will make an entry, import purchase account goods, purchase account debit 70 INR to creditors 70 INR. Correct? On 31st of March, the rate is 72. Now your creditors need to be restated at 72 rupees, recognizing 2 rupees loss. Means you will pay further 2 rupees if you settle today. So you will make an entry, exchange loss account debit 2 rupees, which will be transferred to P&L account to creditors account. Now your creditors will sit at 72 rupees. When you actually pay $1 on 10th of April, you will have to buy $dollar at 73 rupees, and means you will have to pay 73 rupees in short. Correct? So you will further recognize an exchange loss of 1 rupee, exchange loss account debit to creditors account 73, and then the creditors account debit to bank account 73, and the transaction is settled. This happens in case of all monetary items. Okay, settlement date again I am saying closing rates means the rate existed on that date. Here also rate existed on that date. That's what I mean by closing rate. However, if it's a non-monetary item, we continue to carry that at historical cost. Usually, for example, if you have bought a asset, let's say asset is a fixed asset is a non-monetary item, you bought the asset in a foreign exchange, and then that asset is carried, let's say for 5 years in your balance sheet, then you do not restate it every year. You do not use a closing rate every year. You continue to state that asset at historical cost. That means subsequent exchange fluctuations will have no impact on a non-monetary item. This is about the foreign currency transaction, guys. Now, what is para 46 and 46A? Exchange, this is applicable only for companies and this is optional. What it says is exchange differences arising on long-term foreign currency monetary items. If the item is long-term, foreign currency and monetary. Long-term monetary, like long-term liabilities, for example. If it's a loan, like long-term loan, foreign currency loan. Then what it says is, insofar they relate to the depreciable capital assets, it is adjusted to the cost of the asset and depreciated over balance life. I'll tell you what it says. For example, let's say you bought a asset, a depreciable asset, let's say for 1 million or 10 lakh US dollars. Okay, so 10 lakh US dollars, and that time the exchange rate, let's say, was 65, so that makes it 6 crore 50 lakh rupees. So for 6 crore 50 lakh rupees you bought the asset, initially recognized. However, the same is also financed, means you have the equivalent amount of loan and you are repaying the loan. Okay, so if this is a situation, so there is a long-term foreign currency monetary item which is a loan and which relates to a depreciable asset. Now, when you will actually repay the loan, the exchange rate may not be necessarily equal to 65, at which when you borrowed it was 65. It may increase further. Suppose the rate goes up. Suppose the rate becomes 70 rupees and now you will repay the loan at 70 rupees. 5 rupees is the increase per dollar. That means straight away 50 lakh rupees. 50 lakh rupees is exchange loss. Now what happens is the companies were facing a difficulty because ideally this is to be taken to P&L account. And if this is to be taken to a P&L account, the P&L account has a major hit. So that's why a convenient option is given that you can apply para 46 or 46A. Both are actually the same, only the for periods to which it's applicable is different. So they said you have option, rather you don't charge this 50 lakh to P&L account, rather you can capitalize it and depreciate over the life of the asset. But if the exchange difference does not relate to fixed asset, means a depreciable fixed asset, it may relate to anything other than a depreciable asset. Maybe you acquired a non-depreciable asset, maybe, and for which there is a long-term foreign currency monetary items, and you are now repaying, and in the same case 50 lakh is a loss. Now again, if you take this 50 lakh to the profit and loss account, it's a major hit. So, but you cannot add it to the value of the asset because there is no underlying depreciable asset. You cannot add it to the value of the asset because depreciable asset gets depreciated. Suppose it's a land, it will not be depreciated, it's a non-depreciable. You cannot add it simply to the value of the land. No. In that case, they say, in that case, you rather accumulate it in the foreign currency monetary item translation difference, FCMITD account, foreign currency monetary items translation difference account, and over the period of the long-term item you can amortize. Means ultimately that also will be amortized. Ultimately it will go to P&L account, but over a period, not in 1 year itself. Otherwise it would have gone in the 1 year itself. That is para 46 and 46A. Now, what is a forward contract? Let's say, suppose I am importing the goods. I imported the goods for 10 lakh US dollars, and when I imported the goods, let's say exchange rate is 70 rupees. 7 crore rupees I have to pay. Correct? However, payment terms allow me that there is a credit period of, let's say, 2 months. So 70 lakhs I don't pay today, I'll pay after 2 months. But I am really worried. I want to enjoy the 2 months credit period, but at the same time I'm worried that my anxiety is that after 2 months, if the exchange rate is not 70 but it becomes 72, for example, or it becomes 75, then 5 rupees I have to pay more per dollar. That means 50 lakh rupees I have to pay more to the creditor. Straight cash loss to me. Straight cash loss to me. But your friend is telling there is a possibility that instead of dollar increasing, means the exchange Indian rupee weakening, it may be otherwise. Indian rupee may strengthen, and $1 earlier it required 70 rupees. It may happen that it requires only 68 rupees. Then 2 lakh rupees would be the gain to me. 20 lakh rupees would be the gain to me, because I'll have to pay 2 rupees less for every dollar. For 10 lakh dollars, I'll pay 20 lakh rupees less. So I am in a dilemma that whether I 50 lakh the loss possibility is there, 20 lakh profit possibility is there, but I don't want to take the risk. Guys, as a real businessman, I am not interested in exchange gain. If 20 lakh rupees gain does not happen to me, I am okay with it, because I have not considered that in any of my calculations. But if the 50 lakh loss happens to me, I am much more worried, because that is also I have not considered in my calculations. It will straightway go from my pocket. So I prefer to have some insurance policy to cover this risk of exchange fluctuation, and this is where forward exchange contract comes to my rescue. I may go to a bank or certain financial institutions and buy a forward contract. What forward contract I will buy? I will buy US dollars after 2 months, means 2 months forward contract I will purchase for US dollars. Suppose the contract says that the contract rate is, say, 72. The contract rate, forward rate, it is called as a forward rate. Suppose forward rate is 72. That means for 10 lakh US dollars, I will have to pay 7.20 crores I will pay, but not a penny more. Means, suppose after 2 months, if the exchange rate goes up to 75, do I pay 7.50 crores, means 7 crore 50 lakhs? No, I still pay only this much. If the exchange rate falls, I still pay this much. That means my contractual obligation is crystallized, is frozen at this amount. No further risk. This is how a businessman will look at it. But currently 70 rupees is the rate. Because it's a forward, they are charging you 72 rupees. The difference 2 rupees is called as a premium or discount. It is called as a premium or discount, and the AS says that this premium or discount is to be recognized over the tenure of the contract period. Means it will be apportioned over the contract period. Guys, I have put one AS11 lecture also on YouTube, wherein for hedging as well as trading and speculation, how the journal entries will happen, because this apportionment will also happen, plus restatement of both assets and liabilities will also happen, but the impact on P&L will be limited to this premium or discount apportion. So if you want to understand the journal entries, you have to go to that video, but otherwise for exam purpose, premium and discount is to be amortized. Like, for example, suppose on 1st of January, let's say it's a contract, and a forward contract, it's a forward of 5 months. Then Jan, Feb, March, 3 months fall below in the first year, and April and May, 2 months fall in the subsequent period. Then it will be, the premium will be apportioned in the ratio of 3:2. This 2 rupees premium multiplied by whatever dollars will be amortized over 3:2, in the ratio of 3:2 over the period. However, sometimes an entity may enter into forward exchange contract without underlying asset or without underlying liability. Means, here for example, I entered into this contract to secure my transaction, isn't it? to secure my import transaction because I don't want to pay more than 7.220 crores. I entered into forward contract. But suppose I have not imported this, but still I enter into the forward contract. Why? Because suppose I enter into a 72 rupees forward contract. My perception is that dollar will go up to 75. Means I have a forward contract at 72. If it becomes 75, I will buy the dollar at 72 rupees because it's a forward contract, and I will sell it at 75 rupees. So 3 rupees straight away settlement difference I'll gain straight away. But if the spot rate at that time is less than 72, I may lose. And this is not an insurance policy. There is no underlying asset. I am not covering any asset. Simply I am entering into forward contract. It is called as speculation or trading or speculation. In that case, guys, the forward contract is mark to market. Means the value of the forward contract on the reporting date on 31st March is determined. Means now on 31st March, if the forward is for 5 months from January, on 31st March it becomes a 2 months forward because 2 months are remaining before the forward contract lapses. So 2 months forward is the market price. The value of the 2 months forward would be the market value of that forward contract, and it will be marked to market. Means based on the market fluctuations, I will record either gain or I will record a loss. In that case, premium or discount is not recognized separately. So forward rate 72 becomes relevant, current spot rate becomes irrelevant. 72 and on 31st March, what is the remaining period's forward rate? Suppose it is 74, then 2 rupees gain will be recognized. Actual settlement, suppose it is 73, 1 rupees loss will be recognized in the subsequent period. Mark to market, up and down, depends. But in the hedging, premium or discount will be straight away amortized. So there is a systematic allocation of the premium or discount. But in case of speculation, it depends on the market price of the forward, guys. What is a foreign currency operation? Foreign currency operation means subsidiary, associate, joint venture or a branch of a reporting enterprise, the activities of which are based or conducted in a country other than the reporting enterprise, country of the reporting enterprise. India के बाहर है foreign operation. Subsidiary, joint venture and associate, these are actually relevant for consolidated financial statements. CFS is not cash flow, consolidated financial statements. Only branch is more relevant for us at this level. So we'll be more focused upon the foreign branch. Now these foreign operations can be either integral foreign operations, IFO बोलते लोग, या NIFO या NFO, IFO, whatever you call it. If it's integral, then the accounting treatment is different. If it is non-integral, the accounting treatment is different, guys. What is the difference? If it's integral, it is treated just as an extension of your entity, just an extension, integral to you. But if it is a non-integral, it is treated as independent entity. Integral means change in exchange rate will have immediate impact on your cash flows. Non-integral means change in exchange rate, because it's working independently, change in, and there is no much of the cash inflows outflows happening between you, or in a way you can say that change in exchange rate has little impact on your entity, means reporting entity. That is the reason why if it's integral foreign operation, all the exchange differences are transferred to P&L as if it's your own profit or loss. But if it's non-integral, they are accumulated in a foreign currency translation reserve, FCTR, and not transferred to P&L account. So to simplify how we deal with IFO and IFO and NIFO, I have prepared one simple table as to how exchange rates would be applied. Okay, in case of IFO NIFO, suppose if there is opening stock, in both the cases you will apply opening rate. For all expenses income, average rate. By average rate, if average rate is not given, opening rate plus closing rate divided by 2. PPE, non-monetary items, historical rate in case of integral foreign operations, but here there is a difference, guys. You have to note this difference. In case of NIFO, it is closing rate, and all other assets and liabilities like debtors, receivables, current assets, current liabilities, which are monetary, you will use closing rate. Inter-branch transfer, remittances, goods transferred to branch, goods received from branch will be reported at actual. Means in the reporting enterprise entity, whatever amount is recorded, at that amount you will convert it. What we are doing is we are converting a trial balance into Indian rupees. We will take one example also. And exchange difference will go to, so here also you note the difference. Exchange difference goes to P&L, exchange difference goes to foreign currency translation reserve, FCTR. Because you cannot recognize it as your profit because it's a non-integral foreign operation. I have selected 4 questions to discuss. So we'll start with question number 1. Let's read it. Goods purchased on 1st January for $15,000. The rate is 75 rupees. Exchange rate on 31st March is 74. And actual payment happened on 7th July where rate is 73. You are required to ascertain the loss or gain to be recognized for the financial years ended 31st March 21 and 22 as per AS 11. Guys, it's very easy. First of all, goods purchased on 1st January would be recorded at 75 rupees, right? So it would be 15,000 into 75, 11,25,000. Initial recognition will happen. Then reporting date, the exchange rate is 74. So now the creditors will be reported at 11,10,000, 15,000 into 74, 11,10,000. That means your liability reduces from 1125 to 1110. That means you recognize a profit, exchange profit of 15,000, guys. And then you actually pay 73 rupees. So you actually pay 15,000 into 73. If you calculate that, 15,000 into 73 is equal to 10,95,000. So you actually pay 10,95,000. Your liability is at 1110. So further 15,000 will be credited to profit and loss account, and the transaction will be settled. Very easy question. Next, we'll be taking up question number 9. January 21 exam question. Not difficult. Let's read it. Explain briefly the accounting treatment needed in the following cases as per AS 11. First, debtors include amount due from Mr. S, rupees 9 lakh recorded at the prevailing exchange rate on the date of sales. Transaction recorded at $1 is equal to 72 rupees. So if you do 9 lakh divided by 72, is it $12,500, guys? Let's check. Let me write here 9 lakh divided by 72, that means it is $12,500. Okay, then on 31st March the rate is 73.5, and on 1st of April the rate is on 31st March 20 and 1st April 19. The rates are given to you. Okay, so how will you deal with this? Okay, first you have recognized it at 9 lakh rupees, not a problem, and you have to report as on 31st March 20 when the rate is 73.5. guys, rate is 73.5. so now 12,500 into 73.5 is 9,18,750. Now your liability increases to 9,18,750. That's why you will recognize 18,750 as a loss and report the transaction at 918, report the liability as at 9,18,750. This is the first case. Second, there is a long-term loan. So the first case was easy. Let's look at the second one. Long-term loan is taken on 1st April from a US company amounting to rupees 75 lakh. Long-term loan is taken at 75 lakh. Let's again calculate the same way. 75 lakh divided by exchange rate was 72.5, because on 1st of April they say rate is 72.5. The loan is taken on 1st of April. Let me check. 75 lakh divided by 72.5 is some odd amount. Let it be 1,03,448.28. I am rounding it off to 28. These many US dollars. Okay, 1,03,448.28 US dollars. This is a loan amount in US dollars. Okay, 5 lakh rupees repaid on 31st of December at 70.5. Now understand this. 5 lakh. Please, the transactions are to be evaluated properly. 5 lakh recorded at 70.5. Let's do again the calculation. 5 lakh divided by 70.5. How many dollars you have paid? 70 comes to 7092.20 dollars. You have repaid these many dollars, but you initially recorded at 72.5 and you repaid at 70.5, means 2 rupees on this. 7092.2 means into 2 rupees is equal to 14,184.4 would be a profit on this 5 lakh repayment. Exchange gain. I repeat, 5 lakh rupees has been paid where the rate is 70.5. That means you paid 7092.20 dollars. And $1 earlier was 72.5. It reduced to 70.5. 2 rupees is a per dollar gain. So this multiplied by 2 gives me 14,184.4. So this much is gain, guys. Now how much dollars are outstanding? Let's find out. 1,03,448.28 minus 7092.2 means $90. I'm writing in a green here. 96,356.08 dollars are still outstanding. Now we'll go ahead. And interest has been paid as and when. So interest we can ignore, as and when debited by company. US dollar 1 is equal to 73.5 on 31st March. Okay. So now on 31st March, this multiplied by 73.5, this would be restatement. And on this 70, original rate was 70, which was, sorry, 72.5. It has become now 73.5. So on this 1 rupee exchange gain would be recognized. So this is how it will happen, guys. So let us check the answer. 9 lakh first 18, that was a different question altogether, which is correct. Second, 1,03,448 US dollars. Then this much 14, see this much is a profit, and profit minus this loss, the net amount comes to this 67,987.48. How this has been calculated, guys? On 5 lakh this loss profit you must have understood. Now how much dollars remain to be paid, that you have to calculate, and on that you will restate. So I was telling you, sorry for the interruption. So I was telling you that this much profit has been booked, okay, and a loan is taken 75, now 70 lakh. See, there is a little confusion in this calculation, guys. Now what happens is, out of 1,03,000 US dollars, you have already repaid 7092 US dollars. So now 96,356.08 is correct. These many US dollars remain to be repaid. Okay, on the balance sheet date, you have a rate of 73.5 as against 72.5. So on these, what they have done is into 73.5 minus 70 lakh they have done, which in my opinion it should be simply into 1, because if the transaction is denominated in foreign currency, you will have to repay 1,03,448.28 US dollars and not 75 lakh rupees you have to repay. If the transaction is denominated in rupees, then it's a different thing. Okay, is it given long-term loan taken amounting to rupees 75? So by this they mean that the transaction is denominated in rupees. Okay, they have assumed that the transaction is denominated in rupees, but payment is being done in foreign currency, is being settled in foreign currency. So that's why they say that now this is a liability out of which 70 lakh has already been repaid, and the difference minus this profit of 14,184 comes to, gives this net amount. You can afterwards verify all the calculations once again and you will understand it better. Okay guys, so this is how they have solved it. Now let me go to the, yes, there is a little confusion in this question, but this is a solution given by ICAI. But if the transaction is denominated in a foreign currency, the calculation would change a bit. Then going to next question, number 10. Okay. Current Enterprises, having its head office in Mangalore, Karnataka, has a branch office in Greenville, US, and the trial balance is given in US dollars. Whenever such things are given and the question is silent whether it's IFO or NFO, we do not know. We always assume it is integral foreign operation. Guys, we always assume that it is integral foreign operation. So how do we do it? Fixed asset, historical rate, transaction date rate, opening inventory, opening rate, goods received from HO actual, sales, purchase, expense, all at average rate, cash is a monetary item, closing rate, remittances to HO and HO account will be at actual, and exchange rate difference would be the balancing figure, closing stock will be a closing rate, and depreciation would be fixed asset rate. Because fixed asset you have used a transaction date rate, the same rate we use for, always we use for a depreciation, guys. This you might have done earlier, so this is how we convert it. We will see one more question before we conclude AS11. OM Limited purchased item of property, plant and equipment for US dollars 50 lakh on 1st April 19, and the same was fully financed by foreign currency loan US dollar, which is repayable in 5 equal installments annually. Exchange rate at the time of purchase was $1 is equal to 60. As on 31st March, the first, so you have to understand the fact, the loan is for 50 lakh on 1st April 19. The exchange rate was 60. On 31st March 20, when the first installment was paid, rate is 62. The entire loss on exchange was included in the cost of goods sold. OM Limited normally provides depreciation on an item of property, plant and equipment at 20% WDV and exercise the option to adjust the cost of asset for exchange difference arising on the loan restatement and payment. Calculate the amount of exchange loss, its treatment and depreciation of this item of property, plant and equipment. Please read the question little quick once again, and I'll tell you how to analyze it. So the foreign currency loan is 50 lakh US dollars into 60. 50 lakh, let me start the calculations. 50 lakh into 60 is how much? 3,000 lakhs. Okay, suppose I write rupees in lakhs, it is 3,000. Okay, then exchange rate became 62. Okay, when the first installment was paid, as on 31st March 20, the first installment was paid when $1 fetched 62 rupees. So now you have paid the first installment. There are how many installments? There are 5 installments. So out of 50 lakhs, 10 lakhs has been paid, 40 lakhs have remained, and the 40 lakhs outstanding loan, on outstanding loan the exchange loss will be 2 lakh, 2 rupees per unit, that would be 80 lakh. On outstanding loan I am saying this exchange loss would be. So now on repayment, what happens? You have repaid 10 lakhs and exchange loss on the same as well is 2 rupees. 60 becomes 62, guys. 60 has changed to 62, so there is a 2 rupees loss on 10 lakh which is repaid, 2 rupees loss. Outstanding balance on 40 lakhs also there is a 2 rupees loss. That means this is 20 lakh loss which has actually been incurred, and this is on outstanding 80 lakhs. So 80 lakhs would, now what it says is the entire loss on exchange was included in the cost of goods sold, but Om Limited normally provides for a depreciation on 20%. But what is very important, guys, please listen to this. Exercise the option to adjust the cost of asset for exchange difference out of the loan restatement and payment. Correct? It exercise the option to adjust the exchange difference. That means it relates to para 46A. The option is exercised. So this 20 lakh exchange difference on principal amount as well as this 80 lakh exchange difference on principal amount can be added to the PPE, and instead of taking it to profit and loss account, it can be added to the cost of PPE, guys. And the depreciation now will be provided on the revised amount. That means this will be added to the cost, this will be added to the cost, and on the revised cost the depreciation will be provided for. Let's read the answer. The entire exchange loss should be added to the carrying amount of the PPE, and depreciation on the unamortized depreciable amount should be provided. So again, outstanding 80 lakh is a loss, so it should also be added to the corresponding cost in addition to 20 lakh. So the total cost would be increased by 100 lakh, 80 lakh plus 20 lakh, and the depreciation would be on 3100, which is 620 lakh. This is the complete answer, guys, of question number 11. Okay, so this is all about AS11. There are a few more questions. I suggest you do all the question once, go through all the question once. And guys, let's move on to AS12. AS12, accounting for government grants. Government grants are defined as an assistance by government in cash or kind to an enterprise for a past or future compliance with certain conditions. Many a times government grants are received, the accounting will depend upon the type of the grant. We have classified that further into actually 4 types for convenience, and we'll see that. But what is the recognition criteria? The recognition, it says that AS says a government grant is not recognized until there is a reasonable assurance. There has to be a reasonable assurance that the enterprise will comply with the conditions and the grant will be received. And further, AS says that mere receipt of grant is not a conclusive or evidence that the conditions will be fulfilled. So in exam, they may ask you a question that the grant has been received, but there is a significant uncertainty regarding that the compliance will be fulfilled and the grant might have to be refunded if those conditions are not fulfilled. Then, as per AS12, you should recognize the receipt only as a liability, and only when there is a reasonable assurance that the entity will comply with the conditions. Only when the reasonable assurance, obviously there is a lot of judgment is to be exercised as to whether what is reasonable assurance or not, but I am just telling you, in exam if they say there is no reasonable assurance but the grant has been received, will you recognize that as a grant? No. In that case, you will merely recognize that as a liability, and if the refund happens, the liability will be repaid, and if later on there is a reasonable assurance that the conditions will be satisfied, then the grant will be recognized. not necessarily as income. It depends upon the nature of grant, how it will be recognized, but it will be recognized as a grant. That's it. So we have classified grants related to specific assets, grants related to revenue, grants in the nature of promoters contribution, and non-monetary grants, guys. Okay, and in every case we will see what are the methods of accounting treatment, how grant will be treated. Second, if the refund of grant happens, it happens on many occasions that sometimes a grant is received and later on, because of the non-fulfillment of certain conditions, a part of the grant or maybe the entire grant has to be refunded to the government. Then first we have recognized the grant, then how the refund is to be accounted for, that guidance is also given by AS 12. First, very important is, this is not a sequence given by AS, I have just classified it in a convenient sequence. So I am first taking up the grants related to specific fixed asset. If the grant relates to the specific fixed asset, for example, I am investing in a plant and machinery, I am buying plant and machinery, and the government is giving a grant for the purpose of plant and machinery as an incentive, then how do we account for that? There are two methods. First is a simple method, simply deduct the grant from the book value. Deduct the grant from the book value means, suppose the asset original value is 100 lakhs, the grant is, let's say, 40 lakhs, then you will deduct that 40 lakhs from 100, you will recognize 60 lakh as asset. If the grant equals the whole of the cost, means suppose you have acquired the asset for, let's say, 1 CR, grant is also 1 CR, in that case actually the asset value becomes nil, but in that case because we want to show that as an asset, if we show nil, nobody will understand that there is an asset. So even in fixed asset register or PP register, we recognize that at a nominal value may be 10 rupees for example, or 100 rupees maybe. Considering materiality, the 10 rupees can be recognized as an asset and it may be recognized as whatever other income or grant income, 10 rupees, because it will not have any impact, any material impact. Okay, so this is how it is done. Then what is the second method? Instead of deducting from the book value, in case of method 2, if it's a depreciable asset, then we treat that as a deferred income, means grant received will be credited to deferred grant account. So entry will be bank account debit to deferred grant account, simple, and take to PL on a systematic basis over the life of the asset. Usually, suppose for example, you did make this entry, bank account debit to deferred grant account, and asset has already been recognized at full cost. Then usually the deferred grant account is transferred to P&L every year. Suppose let's say the life of the asset is 5 years and you are providing depreciation on straight line method. Even the grant will be transferred on straight line method over the period of 5 years. So usually on a systematic basis, means usually over the life of the asset it is to be transferred to P&L account. So what happens is automatically the net amount that is hit to the profit and loss account is equal to the depreciation. In this case, in the method 1, on the net book value you provide depreciation, in method 2 you provide depreciation on the gross value, but deferred grant proportion of that you credit to P&L account. The net effect is the depreciation at method 1. So effect on P&L is same in method 1 as well as method 2. The net effect is the same. However, if the grant relates to non-depreciable asset, method 1 is the same, we will deduct from the carrying account. Depreciation will not be provided obviously, but in method 2, if it's a non-depreciable asset, for example land, then the grant will be straightway credited to capital reserve account. Because if you defer it, deferred grant means every year you will take a small amount or portion of the amount to the P&L account, but in case of non-depreciable you take nothing to the P&L account, so the grant will be credited to capital reserve. So either you can deduct it from book value, take it to capital reserve, non-depreciable. Depreciable you can consider as a deferred grant. And refund of grant, suppose later on the refund happens because of the non-fulfillment of the condition, suppose you have to refund it, then what will you do? If under method 1 it was deducted from the book value, simply you will increase the book value and provide the depreciation on a revised book value. Obviously, here you compare that for the impairment purpose, that the recognized carrying amount should not exceed its recoverable amount. But anyway, AS 28 is not for our study purpose, not in our syllabus, so I am ignoring that aspect. But simply, you reverse the treatment that you had done earlier. Earlier you deducted it from the book value. Now on refund you increase the book value. Simple. And start depreciating the new book value. In method 2, you will first reduce the refund amount because you have a balance in a deferred grant account, credit balance. You will first make the entry deferred grant account debit to bank on refund of grant. So you will reduce from the deferred grant. But if this is not sufficient balance, then excess will be transferred to P&L account. Grant refunded account will be an expenditure account over and above the deferred grant account. Okay. And in case of non-depreciable, we will first reduce the capital reserve. And if the capital reserve has already been utilized somewhere or transferred somewhere and there is no balance, then the excess will be transferred to P&L account. Rare scenario, usually there will be a balance in the capital reserve and it will be reduced from capital reserve. Okay, this is about specific fixed assets. If the grant relates to the revenue, like power subsidy, there are two methods. First method, credited to P&L account as other income or a separate head. Second method, deducted from expense, means power expenditure is there, the subsidy will be deducted, net expenditure will be reported. In method 1, gross expenditure will be reported and the subsidy received, grant received will be separately credited. On refund of this grant, deduct unamortized balance if any, or excess will be transferred to profit and loss account. If there is some unamortized balance, okay, which usually will not be the case, being it a revenue, only in very rare case when there is a deferment and there is unamortized balance, then it will be reduced from that. But otherwise, this refund will be transferred to profit and loss account. Unamortized balance may remain because you have maybe you have received subsidy in advance, etc., which is yet to be recognized, and the balance remains and it is refunded. Then you will deduct from that. Otherwise, excess will be transferred to P&L account. Grants in the nature of promoters' contribution. For example, in backward areas or backward states, to promote the industries, there are various types of schemes and incentives provided by the government. And the schemes usually are linked to the total investment. For example, in suppose a particular state, because the state lacks in various industrial growth, because the state is looking for the industrial growth, government says you invest 10 crore and we will pay you 30% as a subsidy. Okay, so this is like, and the subsidy will be in the nature of the promoter's contribution. It's a straightaway assistance will be provided to you. Does it relate to a specific fixed asset? The answer is no. In that case, you will treat that as a capital reserve. Central investment subsidy scheme, for example, because there is no repayment which is expected, this amount is given to you as a capital. Government doesn't want it back again. No, treat that as a capital reserve, and on refund you will reduce it from the capital reserve. Apart from this, guys, sometimes non-monetary grants are also received. By non-monetary means, suppose the grant is for a plant and machinery of 10 crores. And instead of you buying 10 crores, then claiming a subsidy and then receiving cash, government says no, we will not pay you cash, we will give you machinery itself. And the 10 crores machinery worth 10 crores is given to you straight away. This is a non-monetary grant. Or the government may say the machinery is worth rupees 10 crores, we will give you only at 4 crores. In a way, 6 crores grant is given to you. So you take machinery but pay only 4 crores for it. So this is non-monetary grant. So in that case, if there is a concessional rate, then account for the asset at acquisition cost. Means suppose 10 crores machinery government gives for 4 crores, you will record it at 4 crores at acquisition cost. But if the asset is provided free of cost, you will record at nominal value. Here there is no option given for deferment of grant. No, that option isn't there. There are only two ways: either if it's a concessional rate at actual cost, concessional cost, whatever it is, which you actually pay, and it's given free of cost, nominal value like 10 rupees, etc., you may record it, guys. So in this one page, we have covered all the aspects relating to the grant, how it is treated. Most common questions are asked on grants related to specific fixed assets, but other questions are also sometimes asked. Sometimes a question on the promoter's contribution is also asked. Simple capital reserve, guys. So in this one page, the treatments of all the grants would be very clear to you. Coming to the questions, guys, I have selected 4 questions and we'll take them one by one. The other questions I leave it to you for reading purpose. Please read all the questions but before going to the exam. So first question we'll be taking up is question number 4. I did not type it. Similar exam question is there. It's okay. It doesn't matter. Okay, let's read the question. Top and Top Limited has set up its business in a designated backward area which entitles the company to receive from the government a subsidy of 20% of the cost of investments for which no repayment. Immediately on reading, you will realize that this is a grant in the nature of the promoter's contribution. There was no condition that the company should purchase any specific asset, etc. Having fulfilled all the conditions, the company on its investment of 50 crores company has invested, received a grant of 10 crores. And the company wants to treat this receipt as an item of revenue and reduce the losses. Can the company do so? Of course not. The only one treatment is allowed, which is taking this to profit and loss account. Here you can, taking this to capital reserve. The correct treatment is to credit it to capital reserve. You have to write all the theoretical aspects, what is the grant in the nature of the promoter's contribution, etc. And then write that it is to be taken to capital reserve. I just give you a minute to read this, quickly read this, so that I will go to the next question. Okay, let's go to question number 8. On 1st April, ABC received government grant of rupees 300 lakhs for acquisition of machinery costing rupees 1,500 lakhs. The grant was credited to the cost of the asset. Okay, method 1 is followed. The life of the machinery is 5 years. The machinery is depreciated at 20% on WDV basis. The company had to refund a grant in May 2014 24, maybe X4, due to non-fulfillment of certain conditions. So understand this. How much grant has been received? 300. Original cost is 1,500. That means you are recognizing the asset at 1,200 lakhs because that is what is given. And WDV 20% is followed. But in May 20X4, how much grant you had to refund? The company had to refund the entire grant, it says. How would you deal with the same? See, first 1,200 lakhs up to 22, 20% depreciation, books value becomes 960. Up to 23, another 20% depreciation, books value becomes 768. 24, another 20% depreciation on WDV, and I have arrived at the book value on 1st April 20X4. Now in May you have refunded the grant. So what we will do is I'll simply add the refund to the carrying amount. Simply I have added refund to the carrying amount, and this is my revised book value. Now on the revised book value, 20% depreciation will be provided over the residual useful life of the asset, remaining useful life of the asset. Now this will be depreciated over remaining useful life. So the rate WDV rate needs to be recalculated. It will not be simply 20% of this amount. Actually, it will have to be calculated using how many years of remaining life remains now. Okay, so on that basis this needs to be calculated. This will be a very complicated calculation. You will have to identify, suppose for example remaining useful life is 10 years, then this amount to depreciate over 10 years, you will have to arrive at a WDV rate based on the formula, but that is not expected in this question. Only explain how you will deal with it. Okay, then next is question number 8. 8 we have done. We have done 2 questions. Next I have selected 9. Yeah. A Limited purchased a machinery for 40 lakhs. Useful life is 4 years. 40 lakh, useful life 4 years, residual value 8 lakhs. That means depreciable amount is 32 lakhs. Government grant received is 16 lakhs. Show the journal entry to be passed at the time of refund of the grant in the 3rd year. If first the grant is credited to fixed asset account and the grant is credited to deferred grant account. Guys, if the grant is credited to fixed asset account and you refund entire 16 lakh, the entry will be fixed asset account debit to bank, because on refund you will simply add it to the cost. Okay, however, if it is credited to deferred grant account, you will have to calculate how much is the balance in deferred grant account. We will have to calculate how much is the balance in the deferred grant account. So let's calculate that. If the grant is credited to deferred grant account, what we'll do is, so allocated to the profit usually over the period in which this, accordingly the first 2 years 8 lakhs will be credited to profit and loss account. Understand this now. Your grant is 16 lakh, your life is 4 years. Okay, so over a 4 years, suppose we are transferring every year equal amount, then 4 lakh every year. That means 8 lakh have been transferred already to profit and loss account, and 8 lakh balance remains in the deferred grant account. So you are refunding 16 lakh, 8 lakh will be reduced from deferred grant. So deferred grant account debit 8 lakh and the excess 8 lakh will be transferred to profit and loss account. Deferred grant account becomes nil and fixed asset now will be shown at 24 lakh. How 24 lakh, guys? Again, how 24 lakh? Understand this. Initially you recorded the fixed asset at 40 lakhs. Grant is credited to separate account. 40 minus 8 is a residual value for calculation purpose. So 32 lakh is a depreciable amount. So 2 years you have already depreciated 16 lakhs. Correct? 2 years. Over 4 years, suppose it gets depreciated. So you already have 40 minus 16. That means 24 lakh is already there. Correct? So depreciation after 2 years, it will be 24 lakhs. So fixed asset will be shown in the books at 24 lakh and depreciation will continue to be charged at 8 lakhs per annum for the remaining 2 years, guys. Okay, so please understand this, because you transferred this amount to a deferred grant account, the fixed asset, and now what you are doing is deferred grant you reversed, but remaining balance you transfer to 8 lakhs and this 24 lakh continue as it is and it will be depreciated for remaining 2 years. Means now over the 2 years you will depreciate it further, but not entire 24 lakh. 8 lakh is a residual value, so 16 lakh would be depreciated 8 lakh and 8 lakh depreciation will continue and it will be reduced to the residual value of 8 lakh, because the figures are same 888. It gets little confusing. Don't get confused, it's very easy. Okay, then next question we have selected is question number 11. Darshan Limited purchased a machinery on 1st April 16. This is January 21 exam question for 130 lakh, useful life 4 years. Government grant received 40 lakh for the purchase. Salvage value is 60 lakh. Darshan Limited decides to treat the grant as deferred income. Again, it's very similar question, and you are required to calculate the amount of depreciation and grant recognized in P&L account for the years 17, 18, 19, 20. 4 years they are asking you. So cost of the asset is 130, salvage value, so this is a depreciable amount, divided by 4, 17.5 depreciation will be provided every year, and total grant is 40 lakh, so 10 lakh will be credited every year. From deferred grant every year 10 lakh will be transferred to P&L account. Guys, AS12 is a very easy accounting standard. If the question comes, then 5 marks are all yours, guys. Let any question come on AS12. Let's move on to AS13. Guys, AS13, accounting for investments. Basically, accounting standard 13 tells you about the treatment of how you deal with the investment, at what cost you recognize investment, depending upon whether it's a current investment or long-term investment. So main classification is current as or long-term, plus some guidance. If it's an investment property, then the guidance is also given as to how to recognize. Investment property means the investment made in, for example, a building for which you are receiving rent, which is given on rent, and you are receiving rent income, like that. So our main focus would be on current investment versus long-term investment, and we'll take care of investment property as well. In both the cases, initial recognition of the investment will be at cost. Obviously, the guidance relating to what is cost is given, which is very much logical as what we would perceive as a cost. The same logic is given. We'll see that. Subsequent measurement means the carrying amount of current investment is lower of cost and fair value. Very important, lower of cost and fair value if it's a current investment. However, if it's a long-term investment, it is usually carried at a cost. Long-term investment is usually carried at a cost. However, if there is a permanent decline in the value of the investment, for example, you have invested in the certain company shares as a long-term investment. So what is current, what is long-term, who will decide? We'll come to that. By current investment, we mean the intention is to hold the investment for short-term period, means a period of less than 12 months. And by long-term investment, we mean the intention is to hold the investment for a longer period, more than 12 months period. Whose intention it is? It is the management's intention. How will you decide what is the intention? You will not decide. Management will decide. Management will tell you that we want to do this as a current investment, we want to do this as a long-term investment. Based on the intention of the management, in the books of accounts it will be shown either as current or long-term. If it's a long-term, it is usually carried at cost. There is little fluctuation in the market value, little here and there. You will not recognize the fair value even if it's lesser than the cost. You will continue to carry the long-term investment at cost. But suppose the company in which you have invested is continuously running into losses, or it loses a major court case, because of which there is a significant doubt about how much value of the investment will be realized. We call it other than temporary decline in the value. Means a decline in the value is there and it is a permanent. There is no possibility to recover. If because of the temporary market fluctuations there is a decline in the value, it may get recovered later on. But if it's like permanent in nature like this, then prudence demands that we make a provision for this permanent diminution in the value of the investment for long-term investment, guys. But current investment is anyway recognized at lower of cost or fair value, and the difference obviously is taken to profit and loss account. Effect of fair value permanent decline, any reduction or any reversals of such reduction are always included in profit and loss account. And where there is a decline other than temporary, the resultant reduction is charged to profit and loss statement. The reduction is reversed when there is again, suppose there is a rise, suppose there is a permanent decline, you made a provision, later on there is again rise in the price of the investment or value of the investment, then you reverse the decline which had happened earlier by reversing the provision. Other important points: valuation of current investments on overall global basis is not considered appropriate. The more prudent and appropriate method is to carry the investments individually scrip wise, shares of A, shares of B, shares of C, or debentures of X, whatever, scrip wise at the lower of cost and fair value. So this comparison of lower of cost and fair value is to be done scrip wise. The long term investment On individual investment basis, obviously it is to be determined. If it's investment property, guys, initially it is recognized at cost, and if subsequently there is a this being a long term in nature, investment property, is it that the property you buy for hold for 3 months only? No, investment property is bought with the intention to hold it for a long term, so there is a permanent diminution, make a provision. The accounting is done as per AS 10, but only cost model, So they may ask you a question that there is investment property. Is it a PPE as per definition of AS 10? Yes, it is investment property, but the cost is recognized just like PPE. Second, the company wants to use a revaluation model, this being a PPE. The answer is no. AS 13 prohibits the use of revaluation model for investment property. Okay, only cost model, which is recommended in AS 10, is to be followed. That's all. Otherwise, how to recognize a permanent diminution in the value and is all the same like long-term investment. Who decides what is current investment, what is long-term investment? It is decided by the intention of the management. So management decides. What is a cost? The cost of investment includes brokerage, fees, duties. Suppose you bought a share, you paid a brokerage. The brokerage is not to be transferred to P&L account. It is to be included as a cost of investment. Okay. If the investment is acquired or partly acquired by the issue of shares or other securities, you issue shares and you acquire investment. Fair value of the securities issued is the value of the investment to be recognized. Cost to be recognized. And if investment is acquired in exchange or part exchange for another asset, in exchange of another asset, then fair value of the asset given up, which you have given up, or the fair value of the investment acquired, whichever is more clearly evident. Usually, even if both are clearly evident, we go by the judgment as to which is more clearly evident, means which evidence is more reliable. Okay, and if, for example, if the investment acquired is the listed shares, then the listed price which is quoted on a stock exchange, the more reliable evidence, isn't it? So we'll go by that. So whichever is more clearly evident, the judgment needs to be exercised. In the exam, they will give you whether this is more clearly evident or that is more clearly evident. Then basic guideline for accounting for interest and dividend. There is a separate chapter, you know, that investment accounting, and you have done a lot of adjustments of cum interest, x interest, cum dividend, x dividend is the same. So if investment is fixed income bearing securities, then the amount that is deducted from the cost is interest accruing before acquisition. Before acquisition, the interest, that is because we pay that much not for investment, but because that much income has already accrued, so we deduct that from the cost of investment, show that as income accrued, and when you realize it, it will get reversed. Okay, but amount acquired, interest accruing after investment is made, is your income. So for example, you made an investment, let's say on 15th of April, then interest till 15th of April will not be your income, it will be reduced from the cost of investment. After subsequent to 15th April, the interest accrued will be your income. But for dividend, the declared from pre-acquisition profit, it's not dividend accruing before acquisition. As a word is different. Declared from pre-acquisition profit, when it is declared, from which profit it is declared. If it is declared from the profit of the year in which you acquired the investment, it is your dividend income. If it is declared from the earlier year's profit, that time you were not holding that investment, that's not your income, it will be deducted from the cost. On disposal of the investment, the difference between the carrying amount and the disposal proceeds net of expenses is recognized in the profit and loss account. When the part of the holding of an individual investment is disposed, a part investment is sold, then the carrying amount is to be allocated to that part on the basis of the average carrying amount. Use the average amount and do it. But in respect of shares, debentures and other securities held as stock in trade, if those shares, securities are held as stock in trade, the cost of stocks disposed of may be determined by applying FIFO or a weighted average, same as AS2. Guys, understand this. So if you are holding in shares, debentures as a stock in trade, you may go by FIFO, weighted average, etc. But otherwise, on disposal, you have to go by average method, and on average cost and average sale proceeds minus average cost of that portion which has been sold, the difference will be either profit or loss. Very commonly asked question in exam: long-term investments classified as current. Current investment reclassified, earlier long-term, now classified as current, or vice versa. When investments are classified from current investments to long-term investments, current to long-term, then transfer is made at lower of cost or fair value at the date of the transfer. This is very important. Sorry, this date of the transfer is really very important. Date of the transfer. For example, in between the year, suppose on 30th of June, management decided to classify certain long-term investments as current investments. Certain current investments as long-term investment. Now, because they are current investment, just a moment before you classify them as long-term, before that, apply the rule for current investments, cost or fair value, whichever is less. So, transfer will be made at lower of cost or fair value. Now, ulta, if long-term to current is being done, then till that moment it is long-term, yes or no? Yes. For long-term, what is the rule? Cost. Except if there is a permanent diminution in the value, we will make a provision. In that case, carrying amount. So it will be transferred as lower of cost or carrying amount. Carrying amount means only if there is a permanent diminution and you have reduced it, then it's a carrying amount or cost, whichever is less. Similar logic, but a question often is asked in the exam. Okay, very easy. Right shares. If the right shares are subscribed, means you receive the right shares offer, you subscribe it, then cost of right share should be added to the carrying amount of the original holding. Simple. Cost of right share should be added to the carrying amount of the original holding, and if the rights are sold, the sales proceeds should be taken to the profit and loss account. Very, very simple. I have explained it by way of one example also. Okay, and I request you to go through these two examples, which will make the situation very clear. Actually, these examples more relate to the chapter investment rather than an accounting standard question. That's why I'm not discussing this in detail, but these examples would help you understand entire position, guys. So coming to few questions, we'll first take up question number 2. Study mat question, nice question it is. X Limited on 1st Jan had made an investment of 600 lakhs in equity shares of Y Limited, of which 50% is made in the long-term category, the rest is a temporary investment. Okay, they classified 50% as long-term, 50% as current. The realizable value of all such investments became 200 lakhs as Y Limited lost a case of copyright. From the given market conditions, it is apparent that the reduction in the value is not temporary. How will you recognize the reduction in the fund? See, understand this. 600 lakh, out of which 300 is long-term, 300 is current. And the realizable value of all investments became 100 lakhs. So this value, 200 lakhs, sorry. So this value became 100, this value became 100, total 200 lakhs. Now, suppose this is a current investment. What is the rule for current investment? Cost or fair value, whichever is less. This is fair value, market value can be taken as a fair value. So 100 lakhs, it will be reduced to 100 lakhs, 200 lakhs loss will be recognized in profit and loss account. For long-term investment, it is recognized at cost. However, if there is a permanent decline in the value, and the question clearly says that they lost a case of copyright, very important case they lost, and the reduction in the value is not temporary, and because of that the reduction in the value is permanent in nature. Obviously in this case also, the 300 minus 100 means 200 provision is to be made for permanent diminution in the value of the investment, guys. So let's read. 600 lakhs, 50%, 300 lakhs is current and 300 lakhs is long term. So lower of cost and fair value. So standard for long term, there is a decline other than temporary, it will be provided, so will also be charged to P&L account. So this is a complete answer, right? All the principles applicable for current investment as well as for long-term investment, and then elaborate it. Okay, you can again use a method of presentation like what accounting standard provides for AS provisions, and then analysis and conclusion. This methodology also can be used. Okay, then next is we'll be taking our question number 4. See, repeatedly this question has been asked. Reclassification. Sometimes they give you two dates, date of balance sheet and date of transfer. Guys, date of transfer is relevant, not the date of balance sheet. If the question is silent, we consider date of balance sheet itself as a date of transfer. By transfer, I mean transfer from current to long term or from long term to current. That date is relevant. If the date is not given, the balance sheet date is usually, we consider that as a date of transfer. A portion, let's read the first question. A portion of the current investments purchased for rupees 20 lakh to be reclassified as long term. Current to long term will be done at cost or fair value, whichever is less. The market value is 25 lakh, cost is 20 lakh, whichever is less, so it will be made at cost, which is 20 lakhs. Second, another portion of current investment purchased for 15 lakh to be reclassified as long term. The market value is 6.5, whichever is less, so it will be at market value 6.5. The loss of 8.5 should be immediately charged to P&L account. Okay. Then third, certain long-term investments no longer considered for holding purposes to be reclassified as current investments. The original cost is 18 lakh, but they had been written down to 12 lakh. So 18 lakhs or 12 lakhs, which is a carrying amount. This is a cost, whichever is less from long-term to current. So again, it will be considered at 12 lakh. As simple as that, guys. Next, we will take up question number 9. The investment portfolio is given 1000 equity shares, 500 equity shares of B and 1000 equity shares of C. The cost is given, the fair value is given. Okay. The company wants to value the above portfolio at rupees 30 lakhs being lower of cost or fair market value. And all these are current investments, guys. Very important. These all are current investments. And second is company wants to transfer 1000 equity shares of C Limited from current to long term as on 31st at cost. So you comments. Now, what they are saying is 30 lakh is a cost, 34 lakh is a fair value, whichever is less. 30 lakh we should value the above portfolio at 30 lakh. Is it correct, guys? The answer is no. You have to do it script wise. So it will be for A, whichever is less 5, whichever is less 10, whichever is less 12. So the correct answer is, because you have to do it script wise, so 27. Guys, 27, you will recognize the portfolio at 27. Second question, company wants to transfer this 15 from current investment to long term at cost of 15 lakh. You cannot do it at cost, you will have to do it at cost or fair value, whichever is less, 12 is a fair value, so you'll have to do it at 12 lakh. Very nice and easy question, guys. See, 27 lakh is the answer, and here 12 lakh is the answer. And obviously you have to write all the explanation. Global basis is not appropriate. You have to do it script wise, category wise, script wise. Okay, then we'll take up one more question, question number 11. A little different question that they asked in RTP November 19. Z Bank has classified its total investment on 31st March 18 into 3 categories: held to maturity, available for sale, held for trading. Guys, this is a classification done by the banks, okay, as per RBI guidelines. This is not a classification given by AS 13. Held to maturity are carried at acquisition less amortized, available for sale at carried at mark to market, held for trading are valued at weekly interval, whatever. You are required to comment whether this is in accordance with AS 13. The answer is of course no. Firstly, AS 13, this standard is not applicable to bank, insurance companies, mutual fund. This is a bank, so AS 13 is not applicable. RBI guidelines, as long as they follow, because AS 13 is anyway not applicable to them, they are very fine. They are good. They have complied with the requirements, guys, because AS 13 is anyway not applicable. And this classification, held to maturity, popularly known as H2M, HTM, AFS, available for sale, and held for trading. This is a popular short form that they use for this. This is as per RBI, not as per AS 13. Not as per AS 13. So you simply write AS 13 is anyway not applicable. So this can be done. They are good to go even if they do this. Guys, we'll come to the last AS of group 1, AS 16. Guys, coming to AS 16, borrowing cost. Borrowing cost is simple words is interest paid on the loan funds, on the amounts which are borrowed from banks, financial institutions and other entities. Obviously not the equity capital, but loan funds. And borrowing cost, the definition also includes certain other ancillary cost, and we'll see the definition in detail. This AS basically tells you that in case of certain assets which take a longer period of time for its construction or acquisition or for its coming into use, it takes a longer period of time. For those assets, if there are borrowings attached to it, the interest can be capitalized. The interest can be capitalized. So AS 16 is basically about how much interest can be capitalized, when it can be capitalized, and it also gives a guidance as to when to start capitalization, when to suspend capitalization, when to cease capitalization and all. So we will touch upon all the aspects one by one. Let's first look at the definition of borrowing cost. Borrowing costs are interest and other costs incurred by an enterprise in connection with the borrowing of the funds. It includes interest and commitment charges on borrowings. What is commitment charges? Sometimes bank sanctions a loan, but you do not take the disbursement in full. Part disbursement you take and interest starts on the part disbursement. But because bank has allocated that much fund for your loan purpose, bank says even if you don't pay interest, pay us some commitment charges. Even if you do not take the loan amount, even if you do not take the disbursement, pay us commitment charges. Those commitment charges also will be treated as borrowing cost. Then amortization of discount or premium on borrowing. Suppose debentures are there, amortization of discount or premium would be borrowing cost. Amortization of ancillary costs related to borrowings. For example, you took a loan from a bank for which you paid stamp duty, documentation charges, etc., legal charges, fees of the lawyer, etc. All those are ancillary costs. Usually those are apportioned. Suppose the loan is for 5 years, those expenses are amortized over a period of 5 years, and this amortization every year is also treated as a borrowing cost. Then finance charges for asset acquired under finance lease. You need a discussion about AS 19. In that, finance charges, if it's a finance lease, the finance charges is also treated as a borrowing cost. And then I said exchange differences to the extent to the extent they are regarded as an adjustment to interest cost. I have a very strong feeling that on this aspect they may ask a question. We'll take one example to understand it better. Okay, so below that I have taken this illustration, but before we take this illustration, what is a qualifying asset? A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Substantial period of time primarily depends on the facts and circumstances of each case. Ordinarily, a period of 12 months is considered as a substantial period of time. However, a shorter or longer period can be justified on the basis of facts and circumstances, and very important, borrowing costs that are attributable to the acquisition, construction or production of a qualifying assets are capitalized. Let me summarize this real quick. First, asset has to be a qualifying asset, means it takes 12 months period to come into for its construction, acquisition, etc. However, sometimes a lesser period also may be considered, but necessarily it takes a longer period. For example, suppose I bought a laptop. Okay, I ordered a laptop from my vendor or from online whatever website, and I used EMI facility for the purpose of making the payment. So laptop, it took suppose 15 days to come to my place. I am claiming I want to capitalize 15 days interest cost. Can I do so? No. Because is laptop a qualifying asset? No. How much time will you wait before you start using it? Not even a minute. Once it comes to you, it is ready to use and you will actually use it. Correct? But it is ready to use immediately. Only the delivery may take a little longer. That doesn't make it a qualifying asset, guys. Number one. Number two, suppose you are constructing a building. Suppose industrial building you are constructing. But because of the technological improvement, your contractor says that we will have it constructed in 8 months or 10 months. Then because AS16 says that 12 months period is a substantial period of time, then it is less than 12 months. Can I still capitalize? Logically, because of the technological improvement or different technology you are using, you are constructing it a little fast. But essentially, if you are constructing any asset, even if it takes a little less than 12 months, 12 months is not a mathematical formula. Less than 12 months, no qualifying asset. More than, no, it is just an indication, a guidance आपको दिया है, indication. So sometimes a lesser period like 8 months, 10 months also can be justified and you can capitalize the borrowing cost of those 8 or 10 months. So we have seen what is borrowing cost, we have seen what is qualifying asset, and we also discussed that only for qualifying asset the borrowing cost can be capitalized. Obviously we will see till what date to capitalize, when to start capitalization, we'll see that. But before that, what is a borrowing cost? We said exchange differences to the extent they are regarded as an adjustment to interest cost also will be treated as a borrowing cost. Quick example, सेम एग्जाम्पल यहाँ पे जो है वही हम कंसिडर करेंगे. XYZ Limited has taken a loan of $10,000 for a specific project at an interest rate of 5%. See, in India, usually the interest rates are high, 9%, 10%, 11%, 12%. Okay, but if you go to a foreign country, you will get, obviously there are certain rules and regulations to follow, but you will get the loans at cheaper interest rates, 4%, 5%, very low interest rates, because in the developed countries the interest rates are usually low. But if you take a foreign currency loan, you get a lesser rate of interest, but there is a risk also, and the risk is of exchange fluctuation. The risk is the risk of exchange fluctuations. So if you are ready to take that risk, you can enjoy the lower interest rates, or if you can hedge that risk somehow, you can enjoy the lower interest rates. But in that case, A says that the exchange fluctuations on principal amount. Okay, so for example, in this case, you borrowed $10,000 at 5%, just at 5% you borrowed. Okay, but if it was in India, this illustration is not complete actually. In the answer, we have completed this, but let me tell you, this is it is suppose given to you that if it was India, you had paid 11%. You had to pay 11% if it was in India, but you are currently paying only 5%. Now what happens is, when you took a loan, the exchange rate was say 45 rupees, but on 31st March it became 48 rupees. Now 3 rupees you lost on your principal amount of 10,000 rupees. Okay, so that means your total increase in liability is 30,000 rupees. Correct? Your total increase in liability is 30,000 rupees, guys. Okay, so actual interest is only 5%. 10,000 US dollars into 5%, you will pay at 48, which is 24,000 rupees. But increase in liability is 30,000 rupees. Now, if you had borrowed in India, you would have paid 10,000 into 45. Why 45? Because you got money at 45 rupees. No, that time exchange rate was 45. So on this amount, you would have paid 11%, which comes to 49,500. So difference between this 49,500 and this original interest cost versus interest cost if you would have borrowed in India, the difference is 25,500. And your increase in liability is 30,000. So increase in liability to the extent of this difference means out of this 30,000, 25,500 will be treated as borrowing cost and remaining 4,500 will be treated as exchange difference to be dealt with by AS 11. And as per AS 11, this exchange difference will go to P&L account. However, if para 46 or 46A is applicable, this may be added to the cost of the asset if it's a depreciable asset, and para 46A is applicable. Okay, so this is how you will deal with it. However, suppose in this case the facts are little different. Suppose the facts are little different, and suppose this increase in liability is not 30,000. Let's say it is only 20,000. But your difference in the borrowing with two different rates is 25,500. Then this 20,000 entirely will be treated as borrowing cost, and exchange difference as per AS 11 would be nil. It will be entirely be treated as a borrowing cost in that case. Okay, these two illustrations are even given in ICI module. Very nice illustration explaining both the cases. So if it is treated as a borrowing cost, and if asset is a qualifying asset, you can capitalize it. And the part which is not a borrowing cost will be an exchange loss. You cannot capitalize it unless para 46A is applicable. If it is applicable, you can add it to the cost of the asset. But this part which is treated as a borrowing cost, if the capitalization of borrowing cost criteria is met, you will capitalize. Coming to the specific borrowing versus general borrowings. First, let me explain to you what is specific borrowing. Specific borrowing means, very simple, we know that this loan is taken and this amount is utilized for plant and machinery, or for building, for furniture, for office equipment, for land, XYZ. We know that these borrowings are specifically made to finance these assets, called as specific borrowings. General borrowings means there are various loans. We have raised funds using debentures and other loan instruments from financial institutions. We have raised finances. We have taken certain loans against properties, etc. And I have utilized those funds for various purposes. Some funds I am utilizing for working capital finance, for financing my working capital. Some funds I am using for acquisition of plant and machinery. Some I am using for construction of the building which is in progress, etc., etc. These are general borrowings because the correlation is not known. So when enterprises borrows funds specifically for the purpose of obtaining a particular qualifying asset, the borrowing costs that directly relate to that qualifying asset can be easily identified. You will easily identify. You know the borrowed funds, you know the interest amount on that, and that much interest, if qualifying asset is there, you will capitalize simply straight away. So the actual borrowing cost incurred less any income on the temporary investment. Very, very important. On this they ask question in exams. For example, you borrowed 10 lakh rupees. Out of that you utilize first 8 lakh rupees, 2 lakh rupees kept idle for 2 months. So you kept it in a bank fixed deposit. You got earned say 5,000 rupees interest on it. then that income from temporary investment will be reduced from the borrowing cost, and the net borrowing cost, if it meets the capitalization criteria, it will be capitalized. Simple. For general borrowings, what we do, and we will take one example where we will see how we deal with the general borrowings. So unless we actually mathematically do it, it's difficult to understand. So we will do it one example little quick. It may be difficult to identify a direct relationship between particular borrowings and a qualifying asset, and to determine the borrowings that could otherwise have been avoided. Okay. So borrowing cost eligible for capitalization in this case should be determined by applying the capitalization rate. So what you do is basically you will calculate a capitalization rate. Guys, you will calculate a capitalization rate. And how do you calculate? It is a weighted average of the borrowing cost. Simply, you will take the borrowings, you will take the interest rates, you will calculate a weighted average. The borrowings may not be outstanding for 12 months. So accordingly, you will consider a time period also, and that's why we call it a weighted average. Okay, amount, time period, and rate of interest. All factors would be considered. And we come to one rate. Let's call it a weighted average rate or average rate. Then actual amount spent, we will apply this average rate. Again, time period we'll consider while applying the average rate. We'll see how we do this, and we capitalize the borrowing cost. In this very important case here, mathematically, because we have calculated a weighted average, in certain circumstances it may happen that borrowing cost to be capitalized comes to 2 lakh rupees suppose, but actual borrowing cost is only 1,95,000. Then you will capitalize entire 1,95,000. You cannot add to the cost the amount which is never incurred as a cost. It will be overstatement of the asset. So the borrowing cost to be capitalized cannot exceed the actual borrowing cost. Always remember this. Borrowing cost to be capitalized cannot exceed actual borrowing cost. How do we do it? We will see in one question. Okay, we will be taking a question number 2 afterwards little while. I'll explain this first, then we'll take question 2 where you will understand how do we do this general borrowings. When to commence capitalization means when to start capitalizing borrowing cost, when to suspend, temporarily pause. देखो यहाँ पे start button है, here is a pause button, and here end means you stop. Cessation of capitalization means you stop capitalizing anymore. Afterwards the interest will go to P&L account. During the suspended period, during the temporary period, interest will go to P&L account, but pause button resumes later on, means pause is a temporary. So commencement, suspension, and cessation. The capitalization should commence when 3 conditions are satisfied. All the 3 conditions are satisfied. Number 1, expenditure for acquisition, construction, or production of a qualifying asset is being incurred. Actual expenditure is being incurred. Second, borrowing cost is being incurred. If you have not borrowed funds, the borrowing cost is not being incurred. How will you capitalize? And third, activities that are necessary to prepare the assets for its intended use are in progress. Activities are in progress, expenditure is being incurred, go hand in hand, and borrowing cost is being incurred. All the 3 conditions are satisfied, you start capitalizing. Suspension. Suppose for example, you are constructing a bridge. Okay, you started capitalizing the borrowing cost, but in between what happened? COVID-19 lockdown, and your activity stopped for 3 months. Same principle which you learn in cost accounting. We do not debit any abnormal cost to cost object. We do not charge any abnormal cost to cost object. Here bridge is a cost object. Assume that it is a cost object. Assume that interest is a cost. Should we charge it to the cost object? The answer is no, because it's abnormal. But that is in cost accounting, the word abnormal is used. Here what do we do is, during the period during which the active development is interrupted. Active development is interrupted. Because of the COVID, 3 months the workers went to their hometowns, home places, native places, and there are no workers. Because of that active work, there is interruption of the work, and during 3 months you did nothing. So the 3 months interest as per A16 you cannot capitalize, correct? However, if the technical and admin work is substantially technical admin work is going on, it is not suspended. Means just because for some technical work is going on, some admin work is going on, some sanction approvals are pending from the government side. Suppose your a bridge is crossing a railway line, and suppose the railway authorities took 15 days for giving you the approval. This is administrative work which is going on, so you do not suspend the interest capitalization for those 15 days. Similarly, suppose during a monsoon season, because of the rains, you have to stop the work for, let's say, 1 month. Will you suspend the capitalization? Again, the answer is no, because is monsoon abnormal? Does monsoon come every year? Yes. Does COVID come every year? Does a strike happens every year? Yeah, you may say, sir, COVID now, it's been 3 years almost now. That's a different story. But I am asking you, does it come every year? No. So if it's a no, then you will suspend it. But monsoon comes every year, so for a few days, because of the rains, if the work is stopped, it happens every time. And this monsoon period you have already factored in. So this is normal. So we do not suspend during that period, guys. Please understand the difference. Coming to the cessation of capitalization. When do you stop capitalization? When it's done, guys. इसके बाद अभी capitalization बंद. Afterwards interest will be transferred to P&L account. When substantially all the activities necessary to prepare the qualifying asset for its intended use are complete. When substantially the activities are complete, even though the routine admin work might still continue, substance over form. For example, your bridge, suppose you are constructing a bridge, it is complete. 100% substantially it is complete. You have finished it, you have painted it, it's ready for inauguration. Only some minister has not yet inaugurated. That's why the handover is pending, maybe, or for some minor paperwork, documentation work, the handover is pending. You do not wait till that handover is complete, because it's substantially complete. You stop capitalization. Prudence also demands it, and now interest you start charging to P&L account. Sometimes completion is in parts. Like for example, you are constructing 2 towers, tower A, tower B, and 1 tower is complete. To that extent, you can stop capitalization. You can cease capitalization of borrowing cost. For another tower that is coming up, the borrowing cost capitalization will continue. We'll take a few questions. We'll first take up question number 2, which is very interesting, nice study material question, which will explain you the specific and general borrowings logic. X Limited began construction of a new building on 1st January. It obtained 1 lakh special loan. So there is a specific borrowing of 1 lakh rupees. The company's other outstanding non-specific loans, means general borrowings, 5 lakh 11%, 9 lakh at 13%, and 1 lakh was at 10%. So 1 specific borrowing, 2 general borrowings. Expenditure month-wise is given. Building was completed by 31st December. See, the information about a calendar year is given from 1st January to 31st December. The information is available. Let's see. Following the principles prescribed in AS 16, calculate the amount to be capitalized and show the journal entry. How do we do it, guys? First, we should calculate always remember these steps. First step is calculate weighted average accumulated expenses. This is not weighted average rate of interest. Expenditure multiplied by time period. See, 2 lakh in January, so 2 lakh for 12 months. 2 lakh 50,000 in April, so Jan, Feb, March gone 9 months. July, from July to December, July, August, September, October, November, 6 months, and December 1 month. Okay, simply we calculate weighted average accumulated expenses. Step 1. Step 2, weighted average interest rate. Very important, weighted average interest rate. I have 2 borrowings, 5 lakh at 11%, I calculated the interest amount. 9 lakh multiplied by 13%, I calculate the interest amount. The total interest amount is 1,72,000. Total borrowings is 14 lakh. Please do 1,17,000 upon 14 lakh. Let me do it. Okay, and I calculated interest rate, guys. 12.285 rounded off. Okay, 12.285%. Now, first I will consider the specific borrowings. Understand this. How much expenditure is actually being incurred? If I take the total of these, 2 lakh plus 2,50,000 plus 4,50,000 plus 1,20,000, this expenditure is actually being incurred, which will be capitalized, guys. This will be capitalized because this is actually expenditure being incurred. And now we'll find out the amount of interest to be capitalized. Now, 6,22,500 is weighted average accumulated expenses. Okay, and 1 lakh is a specific borrowing. Now, because 1 lakh is a specific borrowing, the interest on that will be specifically capitalized. So 1 lakh into 10% will be capitalized 10,000, and remaining 522,500. How I calculated 522,500? This 622,500 minus 1 lakh is 522,500. I will use this average rate 12.285%, and this is a total amount to be capitalized. The entry will be building account debit, total amount this one, to bank. Actually, this entry is given your module, but the better entry would be this much will be capitalized from borrowing cost. So assuming that it is first debited to borrowing cost, the entry would be building account debit 10 lakh 20, sorry, building account debit, or this correct, 1094 189, borrowing cost credit 74,189, and bank account whatever balancing figure 10,20,000 would be more appropriate entry, assuming that this first is debited to borrowing cost. Okay, this entry is not wrong, I'm saying, but more appropriate would be first will debit to the borrowing cost, and the portion that will be capitalized will be transferred to building account. So you better write this way in exam. Okay, then we'll take up next question. I'll go to question number 7. Please read all the questions at once, because in marathon I cannot spend that much time. I'm not discussing all the questions, guys, but you have to do it once. A company incorporated in June has set up a factory within a period of 8 months with borrowed funds. The construction period had reduced drastically due to usage of technological innovations, and the company is able to justify the reasons for the same. Whether the interest can be capitalized because it's taking less than 12 months. Let's read the answer. As per AS 16, a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Further, standard states that what constitutes a substantial period of time depends on the facts and circumstances of case. However, ordinarily, a period of 12 months is considered as substantial period of time unless, very important, unless a shorter or longer period can be justified on the basis of facts and circumstances. So it may be implied that there is a rebuttable presumption that a 12 months period is a substantial period. Under the present circumstances, 12 months period should best be looked at the benchmark and not as a conclusive yardstick. It's a rebuttable assumption, means the assumption that can be negated, that can be reversed. So 8 months we can consider as a substantial period of time, and considering that we may consider that as a qualifying asset. Okay, we can consider this as a qualifying asset and capitalize, guys, even if it's less than 12 months under certain circumstances. We'll take up next question, question number 8. Omega Limited has borrowed a sum of $10 lakh at the beginning of the financial year 1920 for its residential project at 4%. The interest is payable at the end of the financial year. At the time of availment of loan, exchange rate was 56. See, loan, let me use again this color. The loan US dollar 10 lakh, 4% is a rate of interest. Availment rate, exchange rate 56, and as on 31st March exchange rate is 62. If Omega Limited had borrowed in India, it would have paid 10.50%. You are required to compute the borrowing cost and exchange difference. See, let me tell you one thing. Forget about the exchange difference relating to the principal amount. 10 lakh dollars and 56 and 62, 6 rupees is a difference, guys. 10 lakh dollars, 56 and 62 means it increased by 6 rupees. Straight away if I calculate, 60 lakh would be total exchange difference. Out of this, one part would be borrowing cost and one part would be exchange difference to be dealt with by AS 11. Now, one thing is clear, that 60 lakh rupees is exchange difference. Suppose if in India you borrow, how much you would have paid? 10 lakh into 56 you would have received. 10 lakh into 56 you would have received into 10.5% you would have paid. Let me calculate. Some 58.8, and actually how much you pay? 10 lakh into 4%, because the interest rate is 4%, but assume that you pay at 62 rupees, you paid on 31st March the interest. So 10 lakh into 62 into 4%, 24.8. The difference is 34 lakhs, guys. See, 24.8, 58.8, the difference is 34 lakhs. So this difference is a borrowing cost, 34 lakh. The balance is 26 lakh. It would be exchange difference. It will be dealt with by AS 11. 26 lakh to be accounted for as per AS 11. 58.8 out of this, 58.80 would be considered as a borrowing cost to be accounted for as per AS 11. Okay, this is how it will be calculated. The same thing which I explained in the illustration, guys. The same thing that I explained in the illustration. This I believe is an exam question. This is a mock test paper question, and this is exactly the same answer as given in the mock test paper. Next, I am taking up question number 10. Govind Limited issued 12% secured debentures of rupees 100 lakhs. This is RTP question again. 100 lakh debentures have been issued and specifically given construction 40, purchase of machinery 35, working capital, just take a total, 40 plus 35 plus 25 comes to 100 lakhs. Okay, in March 19, the construction of the factory building was completed and machinery was installed and ready for its use. The total interest on debentures is given 12 lakh rupees. The company had invested idle funds, जिसको you get 3 lakh rupees. So net borrowing cost is 9 lakh rupees. Okay, now understand this. On construction of factory building, is it a qualifying asset? Yes. Purchase of machinery, is it a qualifying asset? No. Working capital, is it a qualifying asset? No. You define qualifying asset, you say that this is not a qualifying asset because it doesn't take a substantial period of time for becoming ready for its intended use. Working capital is out of question, so only this much will be capitalized. So 9 lakh into 40 by 100 will be capitalized and all other will be transferred to profit and loss account, guys. Okay, so we have completed the discussion about the 8 accounting standards which are as per new syllabus, which are there in your group 1. If you listen to this video and still there is any doubt, feel free to contact me. The number is given, WhatsApp number is given. You can contact me. I'll try my best to resolve all your doubts. Secondly, download this PDF material. This PDF material is just a compilation. All the answers are also not means the answers are also copied from the institute's material. None of the question is outside the ICAI material. All the questions have been compiled from ICAI material. This I believe consists of 100 questions, and I believe this 100 questions plus in addition to this just focus on the applicability of the accounting standard for companies SMC non-SMC classification other than companies level 1 2 3 classification. Just once at least it will take 20 minutes to understand the classification, and I'll also in the PDF I'll add that as well for your reference. So guys, prepare yourself for 20 marks. These 20 marks are really very crucial. Out of this 20, if you have done this thoroughly, you have referred to this PDF material, the Telegram link is given, I believe you will score more than 15 marks at least. If 20 out of 20 you do, it's best for you. Accounts 1 is a scoring subject. Do score maximum marks in that, and for that AS is a big thing. 20, maybe sometimes 25 mark thing. All the best guys. Do best in exams. I wish you all the best. Thank you so much.